In the beginning, there were merchants who could not sleep at night, their minds racing with numbers that danced like phantoms in the darkness, trying to remember who owed them what, how much grain they had sold, whether the shipment from Alexandria had turned a profit or left them poorer than before. This was the world before double-entry bookkeeping, before the great revolution that would transform not just commerce, but the very fabric of human civilization. And if you think I exaggerate, consider this. Without the accounting methods developed in medieval Italy, there would be no modern capitalism, no industrial revolution, no global economy as we know it today. The story I want to tell you is not merely about numbers in ledgers, though there will be plenty of those, but about how human beings learned to capture reality itself in written form, to create a mirror of economic truth so precise that it could reveal things invisible to the naked eye. Picture yourself in the year 1200, standing in a marketplace in Venice, surrounded by the cacophony of merchants hawking their wares, the smell of spices from the east mingling with the salt air of the Adriatic. And you are a trader who has just concluded a deal that will not be settled for 6 months when a ship returns from Constantinople laden with silk and pepper. How do you remember this transaction? You might make a mark on a tally stick. That ancient device where notches cut into wood represented debts, with the stick then split down the middle, so that both parties held matching records, a system so intuitive and yet so limited that it could barely handle the growing complexity of medieval commerce. Or perhaps you keep a simple list, a memorandum written in narrative form, describing in conversational prose what happened. On the 5th day of March, I, Giovanni, did sell to Marco the draper 3 bales of wool from England, for which he promises to pay me 15 gold florins at Michaelmas. And may God grant that he remembers his obligation. These early records, which historians call bilateral accounts because they track dealings with specific individuals, were essentially stories, little narratives of economic life that reflected how people naturally think about transactions. When you lent money to your brother-in-law, you did not think of it as a debit to accounts receivable but as a favor to family, a relationship maintained through reciprocity and trust, and your records reflected this personal, human dimension. The medieval mind did not yet see the economy as an abstract system of flows and balances, but as a web of personal obligations, each thread connecting one soul to another, and the accounting reflected this worldview perfectly. You can still see this in the account books that survive from the 12th and 13th centuries, where entries read like diary entries. Today, I gave Pietro £12 for the purchase of saffron, and he swears by the Virgin that he will return with either the spice or my money within a fortnight, and I believe him, because his father was an honest man. But something was stirring in the commercial cities of northern Italy, particularly in Genoa, Venice, and Florence, where merchants were engaging in increasingly complex ventures that strained the old ways of record-keeping beyond their breaking point. These were the great trading republics, maritime powers that sent their galleys across the Mediterranean and beyond, to the Levant, to the North African coast, to the Black Sea ports, where Asian goods entered the European market. A single voyage might involve dozens of investors, each contributing different amounts of capital, with profits to be divided according to intricate formulas, and expenses accruing at every port of call. And how could you possibly track all of this using narrative descriptions and bilateral accounts? The cognitive load was simply too great, the margin for error too wide, and fortunes hung in the balance of getting the numbers right. This is where our story truly begins, in the counting houses and trading companies, where practical men, uninterested in philosophy or theory, began to develop new methods simply because the old ones no longer served their needs. They were not inventing accounting from whole cloth. Understand, because human beings have always counted and recorded, from the ancient Sumerians with their clay tablets, to the Romans with their elaborate financial records. But what emerged in medieval Italy was qualitatively different, a conceptual breakthrough that would have ramifications far beyond anyone could have imagined. The key insight, and this is absolutely crucial to understand, was the recognition that every transaction has 2 sides, that when goods or money moves from one place to another, something flows out and something flows in, and if you could capture both sides of this movement simultaneously, you could create a self-checking system that revealed errors and discrepancies with mathematical precision. Let me give you a concrete example to make this clear. Imagine you are a merchant in 14th century Florence, and you purchase £100 of pepper from a spice dealer for 50 gold florins. In the old bilateral system, you might write, bought from Antonio the spice merchant, £100 of pepper for 50 florins, to be paid at Easter. But in the new system of double entry, you would make 2 entries. First, you would record that your pepper inventory is increased by £100, and second, you would record that you now owe Antonio 50 florins. 2 accounts are affected by this single transaction, the pepper account and the Antonio account, and the beauty of it is that they must balance. The increase in one must equal the increase in the other, and if they do not, you know immediately that an error has been made. Now multiply this simple transaction by thousands by the hundreds of deals that a major trading company might engage in over the course of a year, and you begin to see why this was revolutionary. For the first time in human history, merchants could create a complete, integrated picture of their entire business, where every account was connected to every other account through a web of debits and credits, and where the fundamental accounting equation that assets must equal liabilities plus capital provided an iron law that governed the entire system. It was like discovering the laws of physics for the economic universe, rules that were not imposed from outside but emerged from the very nature of exchange itself. And once you understood these rules, you could manipulate them, test them, use them to reveal truths that would otherwise remain hidden. The earliest clear evidence we have of double-entry bookkeeping comes from Genoa in the year 1340, in the account books of the monastery, the treasurers of the city-state, though scholars suspect the system was already in use in private merchant houses for decades before that. These Genoese records show a sophisticated understanding of the principles, with separate accounts for different types of assets and liabilities, with cross-references between entries, with the telltale signs of a system that has been refined through practice. But the true codification, the moment when these scattered practices were gathered together and explained in systematic form, came in 1494, when a Franciscan friar named Luca Pacioli published his Summa de Arithmetica, Geometria, Proportione et Proportionalita, a massive mathematical encyclopedia that included a section on double-entry bookkeeping that would become the foundation for all subsequent accounting education. Pacioli did not invent double-entry bookkeeping, a point he himself made clear in his writing, acknowledging that he was merely describing the method in use in Venice, but his contribution was to take the scattered oral traditions and practical know-how of merchants and transform it into a teachable system, with clear principles and procedures that anyone could learn. He wrote in Italian rather than Latin, making his work accessible to the commercial class rather than just university scholars. And his book was printed rather than hand-copied, multiplied by the miracle of Gutenberg's invention, so that it could spread across Europe with unprecedented speed. Within a generation, double-entry bookkeeping was being taught in the commercial schools of Germany, the Low Countries, England, Spain, anywhere that merchants gathered, and wealth was accumulated. But I am getting ahead of myself, racing toward the end of our medieval period when I have not yet properly explored the middle, the long centuries of development when accounting practices evolved slowly, responding to the changing needs of an increasingly complex economy. Let me take you back to the 13th century, to the great fairs of Champagne, where merchants from across Europe gathered to buy and sell, to extend credit and settle debts, in a vast clearinghouse of international commerce. These fairs operated on a cycle, rotating between different towns throughout the year, and they developed their own sophisticated credit instruments, including the bill of exchange, that marvelous invention that allowed a merchant in Florence to transfer funds to a colleague in Bruges without actually moving gold across the dangerous roads of medieval Europe. The bill of exchange worked like this. Suppose you are a Florentine cloth merchant who has sold woolens in Champagne and now holds French currency that you need to convert back to florins. You could carry the coins home yourself, risking robbery and the perils of travel, or you could find a banker at the fair who has the opposite problem, needing French currency in Champagne but holding florins in Florence. You sell your French coins to the banker at the fair, and he gives you a bill of exchange, essentially a letter instructing his partner in Florence to pay you the equivalent amount in florins. The bill would be payable at a future date, typically 3 months hence, and the exchange rate built into the transaction would include both the cost of the currency conversion and an interest charge, though this latter was carefully disguised because the medieval church prohibited usury, the lending of money at interest, forcing merchants to develop creative workarounds that satisfied both their consciences and their balance sheets. These bills of exchange created an accounting nightmare, or rather, they created problems that the old accounting methods could not adequately handle. A single bill might involve 4 different parties: the original seller of goods, the buyer who owed payment, the banker who issued the bill, and the banker's correspondent who made the final payment. It might be denominated in one currency, but payable in another, with exchange rates that fluctuated between the date of issue and the date of payment. It might be sold or transferred to third parties before maturity, creating chains of obligation that stretched across the continent. How do you track all of this? How do you know, at any given moment, exactly what you own and what you owe, when your assets are scattered in a dozen different currencies and cities, when the value of those assets changes with every shift in the exchange rate? The answer, worked out gradually over decades of trial and error, was to create accounts not just for people and commodities, but for abstract concepts like exchange rate gains and losses, for the passage of time itself as reflected in interest calculations, for the difference between book value and market value, Medieval accountants, entirely self-taught and working from practical necessity rather than theoretical frameworks, were grappling with concepts that would not be formally theorized in economics for another 400 years. They were creating what we might call a symbolic representation of economic reality, a map that was increasingly detailed and increasingly abstract, moving further and further from the concrete particulars of individual transactions toward a generalized mathematical description of financial flows. Consider the account books of the Medici Bank, which we are fortunate to have surviving in remarkable completeness for certain years in the 15th century. These ledgers show a level of sophistication that would not seem out of place in a modern accounting firm. With separate books for different branches of the bank, with accounts for different business ventures kept distinct from one another, with periodic closings and profit calculations, with reserves set aside for doubtful debts, with depreciation charged on physical assets, the Medici accountants understood that a building purchased for 1,000 florins was not worth 1,000 florins 10 years later, that its value declined over time, and this decline needed to be reflected in the accounts. They understood that not every debt would be collected, that some customers would default or disappear, and that prudence required setting aside reserves to cover these anticipated losses. This latter point deserves emphasis because it represents a profound philosophical shift in how people thought about wealth and value. In the earlier medieval period, wealth was largely conceived in static terms, as a stock of gold or land or other tangible assets that you possessed at any given moment. But the new accounting methods revealed wealth as something dynamic, constantly changing, with today's asset becoming tomorrow's loss if market conditions shifted or debtors defaulted. The accounts forced merchants to confront uncertainty, to make explicit their assumptions about the future, to quantify their hopes and fears in the cold language of debits and credits. This was genuinely new in human culture, this idea that you could and should measure not just what you had, but what you expected to have, not just current reality but anticipated future states, and build these expectations into your formal record keeping. The physical appearance of these medieval account books is itself worth contemplating for a moment. They were substantial objects, bound in leather or wooden boards covered with parchment, containing pages of heavy paper or vellum ruled by hand with a straight edge and filled with the elegant script of professional accountants. The ink was iron gall, black and permanent, though over the centuries it has often faded to brown or eaten through the paper with its acidity. The pages were divided into columns, typically with debits on the left page and credits on the right, facing each other across the center binding, and this physical arrangement reflected the conceptual structure of the double entry system, with its emphasis on balance and symmetry. To page through one of these books is to feel the weight of the past, literally, but also to sense something of the mental world of the men who made these entries, the care and precision they brought to their work, the pride they took in neat columns of figures and balanced accounts. Not every medieval merchant used double-entry bookkeeping, and this is an important point that sometimes gets lost in the triumphalist narratives of accounting history. The system was most useful for large-scale enterprises with complex operations, for merchant bankers and trading companies, for institutions like hospitals and monasteries that managed substantial endowments, but a small shopkeeper selling bread or a craftsman making shoes had little need for such elaborate record-keeping. They continued to use simple cash books or even no written records at all, relying on memory and the informal credit arrangements of their local communities. The spread of double-entry bookkeeping was therefore uneven, concentrated in the commercial centers of Italy and gradually radiating outward to other parts of Europe. And even within Italy, there were regional variations, different schools of practice with their own particular conventions and terminology. The Florentines, for instance, developed a reputation for using 3 books rather than 2, adding a memorial or journal between the traditional ledger and the rough notes that merchants jotted down as transactions occurred. This journal served as an intermediate record where transactions were described in narrative form before being posted to the ledger in their abstract debit and credit form, and it created an audit trail, a chronological record that could be consulted if questions arose about how a particular entry had been made. The Venetians had different practices, preferring 2 books and giving each a distinct legal status, with the ledger considered the official record and the journal a mere working document. These differences might seem trivial to modern eyes, but they were taken seriously at the time, with each city proud of its particular methods and suspicious of others. A kind of accounting nationalism that reflected the fierce civic pride of the Italian city-states. One of the most fascinating aspects of medieval accounting, and one that reveals much about the broader culture of the period, is the way that religious and moral concerns were woven into the very fabric of commercial record-keeping. Many account books began with an invocation of God, in the name of God and prophet, a phrase that captures perfectly the medieval synthesis of spiritual and worldly concerns. Merchants saw no contradiction between seeking wealth and seeking salvation. Indeed, They often argued that honest commerce was a form of service to the community, that the merchant who brought goods from distant lands and made them available to customers was doing God's work as surely as any priest or monk, but this justification required that the merchant be scrupulously honest, that his accounts reflect the truth, that he not cheat his customers or partners, and the account books were both a tool for managing the business and a record that would be examined on Judgment Day, when God would audit every transaction and weigh every intent. This religious dimension of accounting had practical consequences. It encouraged accuracy and honesty, certainly, but it also created tensions around issues like usury. The Catholic Church's prohibition on lending money at interest was based on Aristotle's argument that money was sterile, that it could not reproduce itself, and therefore charging for the use of money was unnatural and sinful. But commerce required credit, and credit required compensation for the lender, and medieval merchants developed elaborate schemes to disguise interest as something else. The bill of exchange I mentioned earlier was one such device, where the interest was hidden in the exchange rate between currencies. Partnership agreements were another, where one partner contributed capital and another contributed labor, with profits divided between them in proportions that effectively compensated the capital provider for the use of his money without calling it interest. These arrangements created complex accounting problems. How do you record a transaction that is structured one way on paper, but understood differently by the parties involved? How do you distinguish between legitimate profit, which the church allowed, and usurious interest, which it condemned? The medieval accountants developed sophisticated techniques for navigating these questions, creating accounts that satisfied both the church's moral requirements and the merchant's practical needs. And in doing so, they were performing a kind of ethical interpretation, translating between different systems of value and different ways of understanding economic activity. The partnership was a particularly important institution in medieval commerce and one that drove significant innovations in accounting. Unlike a modern corporation, which has perpetual existence and a legal personality separate from its owners, a medieval partnership was typically a temporary arrangement formed for a specific venture or a specific period of time, often just a few years. When the partnership ended, the assets had to be distributed among the partners according to their shares, and this required a full accounting, a complete reckoning of everything the partnership owned and owed. This periodic closing of the books, forced by the temporary nature of the partnership, meant that medieval merchants developed sophisticated practices for inventory valuation, for calculating profits, for handling depreciation and reserves. All the things that modern accountants do at year-end, but that early medieval merchants might have neglected if they were simply tracking ongoing operations without any need for a final settlement. The Venetian colleganza was one common form of partnership, where one partner provided capital and stayed home while another partner travelled with the goods and conducted the trade. The travelling partner contributed his labour and bore the risks of the journey, and in return he received a share of the profits, typically 1/4, while the capital provider received 3/4. The accounting for such an arrangement was straightforward in principle, but could be complex in practice, especially if the travelling partner made multiple transactions or if some goods were sold at a loss while others yielded profit. The accounts had to track not just the final result, but the entire sequence of transactions, creating a detailed record that could be examined by both partners and that provided protection against fraud or misunderstanding. More complex were the company, the great trading and banking companies of Florence and other Italian cities, which might have dozens of partners and branches in cities across Europe and the Mediterranean. These were essentially multinational corporations avant la lettre, with all the accounting challenges that implies consolidating accounts from different branches, converting between currencies, allocating shared expenses, calculating each partner's share of profit. The Medici Bank, which I mentioned earlier, had branches in Rome, Venice, Geneva, Bruges, London, and other cities, each keeping its own set of books, and the head office in Florence had to periodically consolidate these accounts to get a picture of the overall financial position of the company. This consolidation was done manually, of course, with accountants poring over the books from each branch and transferring the key figures to summary accounts, a process that could take weeks or months, and that was inevitably subject to errors and omissions. The accounting books of these medieval companies reveal something else that is worth noting. They were not purely financial records, but also contained a great deal of information about personalities, relationships, and the human side of business. Margins were filled with comments and observations. This man is a cheat and not to be trusted. Or, may God grant that the ship arrives safely. Or, pay to my son Antonio for his expenses in Bruges. The accounts were personal documents, reflecting the individuality of their keepers, and they had not yet become the standardized, impersonal records that we associate with modern corporate accounting. This personal quality extended even to the language used, which was often a mixture of local dialect and technical terminology, with numbers written out in words rather than Arabic numerals in the earlier period, making the accounts accessible to a wider audience, but also more verbose and harder to scan quickly. Speaking of numbers, the adoption of Arabic numerals was itself a crucial development in the history of medieval accounting, though one that happened gradually over the course of the 13th and 14th centuries. Before this, European merchants used Roman numerals, which are adequate for recording quantities, but nightmarishly difficult for calculation. Try multiplying CX14 by LXCT in Roman numerals, and you will quickly appreciate the problem. The introduction of Arabic numerals, which Europeans learned from Islamic sources, particularly through the work of Leonardo Fibonacci, whose Liber Abaci published in 1202, explained the new number system and its applications to commercial calculation. Revolutionized accounting by making it possible to perform complex calculations directly on the page, rather than requiring an abacus or counting board. But the transition was not instantaneous. Many merchants were suspicious of the new numerals, fearing that they could be too easily altered or forged, that a 0 could be changed to a 6 or a 1 to a 7 with a simple stroke of the pen. Roman numerals, for all their computational inconvenience, had the virtue of being relatively tamper-proof. It is hard to change XXX into a significantly different number without the alteration being obvious. So for many decades, account books used a mixed system, with Roman numerals for the official record and Arabic numerals for calculations and working notes. And it was only gradually, as people became comfortable with the new system and developed safeguards against fraud, that Arabic numerals became universal in accounting. The treatment of time in medieval accounting deserves some attention, because it reveals both the sophistication of the system and some of its limitations. Medieval merchants understood compound interest, the way that interest on interest causes debts or investments to grow exponentially over time, and they developed tables and formulas for calculating present and future values. A bill of exchange payable in 3 months would be valued differently than one payable in 6 months, and the accounts had to reflect these time-based differences. But the medieval period lacked a standardized calendar in the modern sense. Different cities used different systems for dating documents, some counting years from the birth of Christ, others from the founding of the city or the beginning of a ruler's reign, and even the beginning of the year varied, with some places starting on January 1st, others on March 25th, others on Easter. This calendar confusion created practical problems for accountants trying to reconcile records from different locations or to calculate interest accurately over periods that spanned calendar changes. The solution was typically to use multiple dating systems in parallel, noting both the local date and some more universal reference point, and to be very careful when calculating elapsed time to account for the peculiarities of different calendars. It was yet another layer of complexity in an already complex system, and it is a reminder that what we think of as simple and natural, like a standardized calendar, is actually a historical achievement, something that had to be created and imposed through conscious effort. The question of who actually did this accounting work is interesting and sometimes surprising. In the largest companies, there were professional accountants, men who had been trained in the commercial schools that flourished in Italian cities, where boys from merchant families learned arithmetic, bookkeeping, letter writing, and the other skills needed for a commercial career. These accountants were well-paid specialists, often trusted employees who had worked for the same company for decades, and they took pride in their craft, in the elegance of their handwriting, and the accuracy of their calculations. But in smaller enterprises, the merchant himself often kept the books, or his wife did, and we have surviving account books written in women's hands. Evidence that medieval women were sometimes deeply involved in the financial side of family businesses, even if they were excluded from other forms of public economic activity. The role of women in medieval accounting is actually a rich topic that has been somewhat neglected by historians. We know that widows often took over their late husband's businesses, and this meant taking over the accounts as well, learning to understand the debits and credits, the partnerships and obligations, the whole complex web of commercial relationships. Some women were clearly quite skilled at this, managing substantial enterprises successfully for years or decades. We also know that in some trades, particularly textile production, women kept separate accounts for their own business activities, tracking the purchase of raw materials and the sale of finished goods, calculating their own profits independent of their husbands' businesses. These were not mere household accounts, but real business records, using the same double-entry principles as the great merchant companies. And they remind us that the economic world of the Middle Ages was more complex and more inclusive than the simple narrative of male merchants sometimes suggests. The teaching of accounting in medieval commercial schools was very much a practical, apprenticeship-based affair. Students learned by copying examples, by working through problems, by gradually taking on more responsibility in real account books under the supervision of experienced accountants. There were textbooks of a sort, manuscript collections of sample transactions and problems, but the real learning came through doing, through the daily practice of entering transactions and balancing accounts, and correcting errors. Pacioli's great contribution, when he published his Summa in 1494, was to take this oral practical tradition and make it explicit, to lay out the principles clearly so that someone could learn accounting from a book without necessarily having access to a master accountant. This was democratizing in a real sense, breaking down the guild-like control that established accountants had over their craft and making the knowledge more widely available. The double entry system that Pacioli described, and that had been developing in Italy for the previous 2 centuries, was based on a few simple principles that had profound implications. First, every transaction affects at least 2 accounts. Second, for every debit there must be a corresponding credit of equal amount. Third, at any moment, the total of all debits must equal the total of all credits. Fourth, assets equal liabilities plus owner's equity. These principles seem almost trivially obvious once you understand them, but they were not obvious to people who had never encountered them before, and even today, many people find double-entry bookkeeping conceptually challenging, struggling to understand why an increase in assets is a debit, while an increase in liabilities is a credit. Why cash received is recorded differently than revenue earned. The terminology itself is revealing of the historical origins of the system. Debit comes from the Latin debere, to owe, and originally referred to amounts that others owed to you, your receivables. Credit comes from credere, to trust or to loan, and referred to amounts that you owed to others. Over time, these terms became abstracted, applied to any entry on the left or right side of an account, regardless of whether it involved owing or being owed. But the etymological connection to debt and credit, to the fundamental relationships of obligation that underlie all commerce, remains embedded in the language. When a medieval accountant wrote, per cash to merchandise, meaning cash is debited and merchandise is credited, he was describing not just an abstract flow of value, but a transformation of one kind of obligation into another, cash that was owed, to the business. From its owner, becoming goods that were trusted, to the business, by its supplier. The physical layout of the medieval ledger embodied this duality. The book would be opened to face 2 pages, and an account would be spread across both pages, with debits on the left and credits on the right. The account title would appear at the top of both pages, and entries would be made chronologically, with the date, a description of the transaction, and the amount. At the bottom of each page, the column would be summed, and if the account was balanced, if total debits equal total credits, a line would be drawn and the account closed. If there was a difference, it would be carried forward to a new set of pages, becoming the opening balance for the next accounting period. This physical arrangement made the logic of double entry visible at a glance, made errors obvious, and created a record that was both a working tool for managing the business and a permanent archive of what had transpired. One of the subtlest but most important features of double entry accounting is its self-checking nature. Because every transaction is recorded twice, in 2 different accounts, errors tend to reveal themselves. If you record a sale but forget to record the corresponding cash receipt, your accounts will not balance, the trial balance will show that debits and credits are unequal, and you will know that something is wrong. This does not catch all errors. If you record the wrong amount in both accounts, the books will still balance, even though the figures are incorrect. And if you record a transaction in the wrong accounts entirely, the system will not detect the mistake. But it catches many errors, and more importantly, it creates a discipline of verification, forcing the accountant to constantly check his work, to trace transactions through the books, ensuring that every debit has its credit and every credit its debit. This self-checking quality was understood and valued by medieval merchants, who operated in a world where fraud was common and verification difficult. If you were a partner in a venture and you wanted to know whether your co-partner had been honest in his dealings, you could examine the accounts, and, if they balanced, if every transaction could be traced from the journal to the ledger, from the ledger back to the original documentation, you had reasonable confidence that the records were accurate. Not perfect confidence, because skilled fraudsters could manipulate double-entry books, just as they could manipulate any other records, but much better than the old narrative systems, where it was difficult to verify anything without going through every single transaction individually. The development of the trial balance as a formal procedure, a periodic listing of all account balances to verify that debits equal credits, was an important innovation that emerged in the later medieval period. Early practitioners of double-entry bookkeeping understood the principle that the books must balance, but they did not always have a formal procedure for checking this. They might discover imbalances only when trying to close accounts at the end of a venture, or when some discrepancy became obvious in the course of business. The trial balance, typically prepared monthly or at other regular intervals, made the checking systematic and routine. And it created opportunities to catch errors while they were still fresh in memory, when the original documents were still readily available and the parties to the transactions could still be consulted. Medieval accounting also developed increasingly sophisticated approaches to the problem of periodic reporting, the question of how to determine profit or loss for a given period of time, when transactions span multiple periods and when assets have value that extends into the future. Consider a merchant ship that makes a 2-year voyage to the Levant and back, incurring expenses along the way and generating revenues from the sale of goods at various ports. How do you allocate these expenses and revenues to particular accounting periods? Do you wait until the voyage is complete and then recognize all the profit or loss at once, or do you try to estimate progress along the way and recognize profit gradually? Medieval accountants wrestled with these questions, developing rules of thumb and conventions that varied by industry and locality, but that generally reflected a conservative bias, a preference for recognizing losses immediately and deferring the recognition of gains until they were certain. This conservatism was partly a matter of prudence, a recognition that anticipated profits might never materialize, but it was also influenced by religious concerns about the sin of presumption, the arrogance of counting your chickens before they hatched. There was a moral dimension to the accounting treatment of uncertainty, with overly optimistic valuations seen as not just technically incorrect, but ethically questionable, a form of lying to yourself and to God. The accounts were supposed to reflect truth, and truth required acknowledging what you did not know, what remained uncertain, what was in God's hands rather than your own control. The treatment of depreciation, which I mentioned briefly earlier, deserves more extended consideration because it reveals the sophistication of medieval accounting thought. Depreciation is the recognition that physical assets lose value over time through use or obsolescence, and properly accounting for it requires estimating both the useful life of the asset and its residual value at the end of that life. Medieval accountants did not use the term depreciation or develop the systematic formulas that modern accounting employs, but they understood the concept and applied it in practical ways. A merchant might purchase a warehouse for 1,000 florins and recognize that in 10 years it would need major repairs, setting aside 100 florins per year to create a reserve for this anticipated expense. This was depreciation under another name, a way of matching the cost of the asset to the periods that benefited from its use. The Medici Bank, as evidenced in its surviving accounts, depreciated furniture, equipment, and buildings, though the rates and methods were not standardized and seem to have been based on the judgment of the accountants rather than any formula. What matters is that they recognized the need to do this, that they understood that showing the original purchase price of an asset year after year even as it wore out was misleading and created an inflated picture of the company's wealth. This understanding came from practical experience, from watching assets deteriorate and eventually need replacement, and from the financial disasters that befell merchants who failed to set aside resources for depreciation and found themselves unable to replace essential equipment when it finally gave out. Another area where medieval accounting showed remarkable sophistication was in the treatment of bad debts, the recognition that not every customer would pay what they owed, and that prudent merchants needed to anticipate this. Early medieval accounts often showed debts carried on the books for years, even decades long after any realistic hope of collection had passed, inflating the apparent assets of the business and giving a false picture of its financial health. More sophisticated merchants developed the practice of creating reserves for doubtful debts, setting aside a portion of profit to cover anticipated losses from non-payment. The Medici accounts show such reserves calculated as a percentage of outstanding receivables, with the percentage varying depending on the accountant's assessment of the quality of the debt. Amounts owed by well-known, credit-worthy customers might require only a small reserve, while debts owed by more questionable characters might be fully reserved, in effect written off even though formal legal collection efforts continued. This practice required judgment, and good judgment required knowledge of the customers, their characters, their financial situations, their track records in meeting obligations. The accounting system did not just record numbers, but captured human behavior, the patterns of payment and default that revealed who could be trusted and who could not. In this sense, the medieval account books were also credit reports, repositories of information about reputation and reliability that had real economic value. A merchant who kept good records knew which of his customers were good risks and which were not, and this knowledge, preserved in the accounts, was itself an asset of the business, part of what made it valuable and worth protecting. The question of asset valuation more broadly was a constant challenge for medieval accountants. At what value should inventory be carried on the books? The price paid for it? The current market price? The expected selling price? Different situations called for different answers, and medieval practice varied. But there was a general principle that assets should be valued conservatively, at cost or market value whichever was lower, recognizing losses promptly but not anticipating gains. This principle, known today as the lower of cost or market rule, has ancient roots in this medieval preference for caution and in the ethical imperative to not overstate one's wealth. The complexity of currency transactions in medieval commerce created particularly thorny accounting problems. A merchant operating across Europe might hold assets denominated in dozens of different currencies: florins, ducats, pound sterling, French livres, marks of various German cities, and many others. Exchange rates between these currencies fluctuated constantly, driven by changes in the relative supply of precious metals, by political disruptions, by shifts in trade balances, and by the activities of money changers and bankers who profited from arbitrage. How should accounts reflect these fluctuations? Should assets be valued at the exchange rate that prevailed when they were acquired, or at the current rate, or at some average? And when exchange rates changed, creating gains or losses on foreign currency holdings, should these be recognized immediately or deferred until the currency was actually exchanged? Medieval practice evolved toward a system where exchange rate changes were recognized as they occurred, creating gains or losses that affected the calculation of overall profit. This meant that a merchant might show a profit from his trading activities, but a loss from currency fluctuations, or vice versa, and the accounts needed to distinguish between these different sources of profit and loss. The Medici Bank kept separate accounts for exchange rate movements, allowing managers to see at a glance how much of the bank's profit came from ordinary business activities and how much from currency speculation. And this information was crucial for making strategic decisions about which currencies to hold and when to convert from one to another. Let me pause here to reflect on what we have covered and what remains to be explored in this vast topic. We have traced the evolution of accounting from simple narrative records to sophisticated double-entry systems. We have seen how practical business needs drove innovation, how religious and ethical concerns shaped accounting practice, how the development of new institutions, like partnerships and bills of exchange, created new accounting challenges and new solutions. We have examined the physical form of medieval account books, the language and terminology, the people who kept the books, the teaching and transmission of accounting knowledge. We have looked at specific technical issues like depreciation, bad debt reserves, currency translation, and periodic reporting. But there is much more to say about the broader significance of medieval accounting, about its role in the development of capitalism, about its relationship to other intellectual currents of the period, about its eventual spread beyond Italy to the rest of Europe and eventually the entire world. Let me continue with these larger themes, trying to place medieval accounting in its full historical context and to help you understand why this seemingly dry technical subject actually matters profoundly for understanding the modern world. The relationship between the development of double-entry bookkeeping and the rise of capitalism has been debated by historians and social theorists for over a century. The great German sociologists Max Weber argued that rational accounting was one of the essential preconditions for capitalism, that without the ability to calculate profit and loss accurately, to plan and budget, to distinguish between capital and revenue, businesses could not operate on the systematic, rationalized basis that capitalism requires. The medieval Italian merchants who developed double-entry bookkeeping were, in Weber's view, creating the intellectual tools that would make capitalism possible, though they could not have known what they were creating. Other scholars have pushed back against this view, noting that sophisticated commerce existed long before double-entry bookkeeping, that ancient Rome and medieval China and the Islamic world all had complex economies without developing this particular accounting method. They argue that double-entry bookkeeping was more a consequence of capitalist development than a cause, that it emerged when businesses became large and complex enough to need it, not that it made large and complex businesses possible. This debate cannot be definitively resolved, and probably both sides have part of the truth. Accounting methods both enable and respond to economic development in a reciprocal process where each advance in one area creates pressure for advances in the other. What is undeniable is that double-entry bookkeeping changed how merchants thought about their businesses. Before double-entry, a merchant knew whether he was getting richer or poorer, whether a particular venture had succeeded or failed, but he had little precise knowledge of his overall financial position at any given moment. With double entry, he could close his books at the end of a year and calculate exactly how much profit he had made, exactly what his net worth was, exactly how much was tied up in inventory versus receivables versus cash. This quantification, this reduction of the messy reality of business to precise numbers, created a new way of seeing, a new form of consciousness that we might call economic rationality. The double-entry accounts encourage merchants to think in terms of return on capital, to ask not just whether a venture made money, but whether it made enough money to justify the capital invested in it. If you put 1,000 florins into a trade voyage and got back 1,100 florins, you made a profit of 100 florins, but was that good or bad? It depends on how long the voyage took, on what else you might have done with the capital, on the risks you bore. Double-entry accounting made it possible to calculate rates of return, to compare different investments, systematically, to allocate capital to its most profitable uses. This was capitalism before the word existed, the systematic pursuit of profit through the calculated deployment of capital resources, and the account books were the instruments that made such calculation possible. Consider how different this is from the economic mentality of the early Middle Ages, when wealth was conceived primarily in terms of land and the produce of land, when the goal of economic activity was sustaining a household or estate rather than maximizing profit, when commerce was viewed with suspicion as a morally dubious activity engaged in by marginal figures. The merchant with his account books, calculating profits and planning future ventures, represented a completely different worldview, one where economic activity was respectable, where wealth could be created through trade and finance, where rational calculation, rather than tradition or custom, determined what to do. This was not yet the full-blown capitalism of the Industrial Revolution, but it was a crucial step in that direction. The spread of double-entry bookkeeping from Italy to the rest of Europe in the 15th and 16th centuries coincided with and facilitated the great expansion of European commerce that we call the Commercial Revolution. Dutch and German and English merchants learned Italian accounting methods and adapted them to their own circumstances, developing local variations and innovations. The great chartered trading companies, like the Dutch East India Company and the English East India Company, used elaborate accounting systems based on Italian principles, but expanded to handle the vast scale and complexity of their operations. These companies were among the first large-scale business organizations in history, and they could not have functioned without sophisticated accounting. The joint stock company, where many investors pooled their capital and shared in the profits according to their shareholdings, was a major institutional innovation that depended crucially on reliable accounting. Investors needed to know what their shares were worth, what dividends they were entitled to, whether the company's managers were using the invested capital wisely or squandering it. The accounting system provided this information, creating transparency and enabling trust between investors and managers who might not know each other personally. This was the beginning of the separation between ownership and control that characterizes modern corporate capitalism. And it was made possible by accounting systems that could accurately measure and report financial results. The governmental applications of double-entry bookkeeping also deserve attention. Medieval city-states and later national governments began adopting these methods for tracking public revenues and expenditures for managing the complex finances of increasingly centralized states. The Genoese city government was using double-entry by the early 14th century, as I mentioned earlier. And other Italian cities followed. By the 16th century, the Spanish crown was using double-entry methods to track the vast flows of silver from its American colonies. And the accounting records they created are now invaluable sources for economic historians trying to understand the impact of New World treasure on the European economy. Government accounting raised new issues that commercial accounting did not face. A business exists to make profit, and the bottom line of the profit calculation is the ultimate measure of success or failure. But what is the bottom line for a government? How do you account for assets like roads and fortifications that provide public benefits but generate no revenue? How do you handle taxes, which are not really sales of goods or services, but compulsory transfers of wealth? The adaptation of double-entry bookkeeping to governmental purposes required conceptual innovations, new categories of accounts, new ways of thinking about value and obligation that would eventually develop into the distinct field of government or fund accounting. The question of accounting for non-profit institutions, like hospitals, charitable foundations, monasteries, and universities, was similarly challenging. These organizations had revenues and expenses, assets and liabilities, but no profit motive and no shareholders to whom they owed reports. What was the purpose of their accounting? Primarily accountability in the moral sense, demonstrating to donors and to ecclesiastical or civil authorities that the trust placed in the institution's managers was justified. Medieval hospital accounts show meticulous tracking of expenditures on food, medicine, and care for the poor, with separate accounts for different categories of expense and periodic reports to boards of governors. This tradition of non-profit accountability, rooted in medieval religious institutions, continues today in the reporting requirements placed on charities and other tax-exempt organizations. One aspect of medieval accounting that I have not yet adequately addressed is its limitations, the things it could not do or did not do well. Perhaps the most important limitation was the lack of any concept of the business as a continuing entity separate from its owners. Medieval partnerships were temporary, and even ongoing businesses were conceived as extensions of the merchant's personal economic activity rather than as independent entities. This meant that there was no clear distinction between business assets and personal assets, between business income and personal income. A merchant might use business funds to purchase a house for his family, or conversely, might inject personal funds into the business when it needed capital, and the accounting reflected these flows, but did not problematize them the way modern corporate accounting would. This lack of entity separation was related to the legal status of business organizations in the medieval period. The corporation as a legal person, with rights and obligations distinct from those of its members, was still in its infancy. Most businesses were owned by individuals or temporary partnerships, and while there were some exceptional cases of ongoing corporate entities, like the great guilds or certain municipalities, the general principle was that businesses were owned by persons who bore unlimited personal liability for the business's debts. If a venture failed, creditors could pursue not just the assets of the business, but the personal assets of the merchants who owned it. This created a different relationship between the merchant and his business than we see in the modern world of limited liability corporations. Another limitation of medieval accounting was the absence of standardization. Every merchant or company developed its own particular methods, its own chart of accounts, its own format for the ledger and journal, its own conventions for recording transactions. This made it difficult to compare one company's accounts with another's, difficult for a merchant trained in one system to work with accounts kept under another system. Pacioli's Summa represented the first step towards standardization by describing a common method that could be taught and learned. But true standardization would not come until much later, with the development of generally accepted accounting principles and formal regulation of accounting practice in the 19th and 20th centuries. The lack of standardization also meant that there was no accounting profession in the medieval period in the sense that we understand it today. There were professional accountants, individuals who made their living keeping books for merchants or companies, but there was no organized profession with entrance requirements, ethical standards, professional qualifications and the like. Anyone could hang out a shingle as an accountant, and quality varied enormously. Some accountants were highly skilled and knowledgeable, while others were barely literate charlatans who bungled the books and caused their employers great losses. There was no professional liability insurance, no board of accountancy to discipline misconduct, no way for a merchant to verify that a prospective accountant actually knew what he was doing except by examining his work or checking his references. The question of audit and assurance is particularly interesting in the medieval context. Modern accounting distinguishes sharply between bookkeeping, which is the recording of transactions, and auditing, which is the independent verification that the books accurately reflect what actually happened. In the medieval period, this distinction was less clear. Some large organizations had internal auditors, employees whose job was to check the work of other accountants and to look for errors or fraud, but independent external audits of the sort that publicly traded companies must undergo today were essentially unknown. When partners in a venture wanted assurance that the accounts were accurate, they typically examined the books themselves or hired an accountant they trusted to do so, but this accountant was acting more as a consultant than as an independent auditor in the modern sense. The potential for fraud was considerable, and medieval merchants were keenly aware of it. Account books could be altered, erased, or destroyed. False entries could be made to hide embezzlement or theft. Collusion between multiple parties could create fictitious transactions that appeared legitimate in the accounts, but that served only to enrich those involved at the expense of other partners or creditors. Some of the accounting innovations of the period can be understood as responses to these risks. The use of bound books rather than loose sheets to make it harder to remove pages, the practice of making entries in permanent ink rather than erasable media, the requirement that each entry be dated and initialed by the accountant who made it, the prohibition on leaving blank lines or spaces that could later be filled in with fraudulent entries. Despite these safeguards, fraud was common, and spectacular accounting frauds sometimes led to the collapse of major merchant houses. The Peruzzi and Bardi banks of Florence, which are among the largest financial institutions in 14th century Europe, both failed in the 1340s, in part because of bad loans to European monarchs, but also because of internal fraud and mismanagement that the accounting system failed to prevent or detect. These failures sent shockwaves through the European economy, ruining investors and disrupting trade, and they served as cautionary tales about the importance of reliable accounts and trustworthy accountants. The relationship between accounting and law was complex in the medieval period. Account books were generally recognized as evidence in legal disputes, but their evidentiary value depended on the reputation of the accountant and the physical integrity of the books. A book that showed signs of alteration, or that was not properly bound and authenticated, might be rejected by a court, while one that was well kept and vouched for by respectable witnesses might be given great weight. Some cities and regions developed formal requirements for commercial account books, specifying what kind of paper or parchment to use, how entries should be formatted, when and how books should be authenticated by notaries or public officials. These regulations represented early attempts at creating legal standards for accounting, though they were far from uniform and enforcement was often lax. The role of the notary in medieval commerce deserves mention here. Notaries were public officials who authenticated documents, creating records that had legal force and that could be relied upon in court. Many important commercial transactions were documented by notaries, who would create a formal instrument describing the terms of a contract or recording a payment or debt. These notarial records existed alongside the private account books of merchants, and sometimes there were discrepancies between them, creating questions about which record should be believed. Generally, notarial records were given more weight because of their public character, but merchants' accounts were also respected, especially if they were well maintained and supported by other evidence. The question of when accounting records became public versus remaining private is interesting. In general, medieval merchants guarded their accounts jealously, treating them as proprietary information that competitors should not see. The accounts revealed not just financial results, but also business strategies, customer lists, supplier relationships, profit margins, all information that could be valuable to rivals. Some cities required merchants to periodically declare their assets for tax purposes, but even this was often based on sworn statements rather than detailed examination of the accounts. The idea that accounts should be made public, that investors and creditors had a right to see detailed financial information, only developed gradually and did not become firmly established until the modern era of securities regulation and mandatory disclosure. Let me turn now to some of the intellectual and cultural dimensions of medieval accounting. The ways that this apparently technical subject connected to broader currents in medieval thought and society. One connection is to mathematics, obviously, since accounting is fundamentally a quantitative discipline. The development of more sophisticated accounting methods both depended on and encouraged advances in mathematical knowledge. Merchants needed to know arithmetic, to be comfortable with fractions and proportions, to understand compound interest and present value calculations. The commercial schools of Italy taught mathematics specifically for business purposes, with problem sets drawn from real commercial situations. If three partners invest unequal amounts in a venture and agree to divide profits proportionally, how much does each receive? If I lend a sum at a certain rate of interest for a certain period, how much will be owed at maturity? This commercial mathematics was quite sophisticated, often more advanced than what was taught in universities, where mathematics was still largely conceived in terms of Euclidean geometry and Aristotelian natural philosophy rather than practical calculation. The treatises on commercial mathematics that survive from the medieval period show impressive technical skill and reveal that Italian merchants were working with concepts like compound interest, geometric series, and algebraic equations long before these were formalized in academic mathematics. Fibonacci himself was a merchant's son who learned mathematics in the commercial centers of the Mediterranean, and his great work was in many ways a synthesis of commercial mathematics with the Arabic mathematical traditions he had encountered in his travels. The connection between accounting and the development of symbolic notation is also worth noting. The evolution from narrative descriptions of transactions to standardized symbolic entries, with debits and credits represented by conventional signs and formats, paralleled broader developments in mathematical and scientific notation. The use of Arabic numerals, as I mentioned earlier, was one aspect of this, but there was also the development of specialized abbreviations and symbols for currency units, for weights and measures, for technical accounting terms. This symbolic language made the accounts more compact and easier to scan visually, but it also made them more abstract, more removed from the concrete particulars of real transactions. Some scholars have argued that there is a deep connection between the development of abstract, symbolic representation in accounting and the broader intellectual movement toward abstraction and formalization that characterizes the late medieval and early modern period. The same impulse that led astronomers to describe planetary motion in mathematical terms, that led lawyers to create systematic codes of law, that led theologians to construct elaborate logical demonstrations of religious doctrines, also led merchants to represent their economic activities in the abstract language of debits and credits. This is perhaps too grand a claim, but there is surely something to the idea that accounting was part of a broader cultural shift toward rational, systematic, formal methods of knowledge and control. The religious dimensions of accounting that I touched on earlier are worth exploring further. The medieval church had a complex and often contradictory relationship with commerce and wealth. On one hand, there was a strong tradition of condemning avarice and commercial activity, of seeing the pursuit of wealth as a distraction from the pursuit of salvation, of valorizing poverty as a spiritual virtue. On the other hand, the church itself was a major economic actor, owning vast estates, engaging in trade and finance, accumulating treasure. The monasteries, which were supposed to be communities of people who had renounced worldly concerns, were often among the most economically sophisticated institutions of their time, using advanced agricultural methods, operating mills and workshops, keeping elaborate accounts. This tension between religious ideals and economic realities played out in interesting ways in the development of accounting. Merchants wanted to believe that their activities were morally legitimate, that they could pursue profit without imperiling their souls. And they developed theological justifications for commerce based on the argument that trade served the common good by making goods available where they were needed. The account books, with their emphasis on honesty and accuracy, with their invocations of God and their expressions of piety, were part of this justification. The merchant who kept good accounts was demonstrating his moral rectitude, his commitment to truth, his fitness to be trusted with wealth. The accounts were not just business records, but moral documents, evidence that would be presented on Judgment Day. The practice of opening account books with religious formulas, in the name of God and profit, captures this perfectly. God and profit were not opposed but aligned. The pursuit of legitimate profit through honest trade was a form of service to God, who had created the world and ordained that humans should use its resources wisely. The accounts themselves were a form of stewardship, showing how the merchant had used the talents entrusted to him, whether he had been faithful servant who multiplied what he was given, or slothful servant who buried his talent in the ground. This biblical language of talents and stewardship was more than metaphor for medieval merchants. It was how they understood their own activity, and it shaped their accounting practices. The question of how accounting, related to the emerging sense of individualism in the late medieval period, is complex and has been much debated by historians. Some argue that the emphasis on individual profit and loss, on calculating one's personal financial position, contributed to the development of a more individualistic, self-interested worldview that was a key component of the transition from medieval to modern society. The merchant poring over his accounts, calculating his wealth, planning his next venture, was a new kind of person, one who conceived of himself primarily as an autonomous economic agent, rather than as a member of a household, a community, a corporate body. The accounts were tools for this self-conception, ways of defining and measuring the self in economic terms. Others are more skeptical of this argument, noting that medieval merchants still conceived of themselves as embedded in networks of family, guild, neighborhood and city, that their economic activities were deeply social, involving partnerships and credit relationships that bound them to others. The accounts reflected these social dimensions, tracking not just individual wealth, but shared ventures and mutual obligations. The tension between individual and community, between self-interest and social obligation, runs through medieval commercial life and is reflected in the ambiguities and contradictions of the accounting records. Let me conclude by stepping back and considering the legacy of medieval accounting, the ways that this distant past continues to shape our present. The double-entry system that emerged in medieval Italy is still the basis for accounting today, essentially unchanged in its fundamentals, despite enormous changes in technology and in the scale and complexity of economic activity. When a modern accountant records a transaction in a computerized accounting system, making debits and credits that must balance, checking a trial balance to ensure that the books are in order, preparing financial statements that show assets, liabilities, and equity, she is using methods and concepts that would be recognizable to a Florentine accountant from 600 years ago. This remarkable continuity suggests that the medieval accountants discovered something fundamental about economic reality, a way of representing transactions that captures essential features that remain constant across different technologies and economic systems. The basic insight that every transaction has two sides, that flows in must be balanced by flows out, the value does not simply appear or disappear but moves from one location to another, this seems to be a deep truth about exchange that transcends particular historical circumstances. The medieval merchants who developed double-entry bookkeeping were discovering the grammar of economic language, the fundamental structure that any adequate system of economic representation must possess. At the same time, medieval accounting was a product of its particular time and place, shaped by the specific needs and constraints of medieval commerce, by the religious and ethical concerns of medieval culture, by the limitations of medieval technology and organization. Some features of medieval accounting have not persisted. We no longer open our books with invocations to God. We distinguish sharply between personal and business assets. We have standardized methods and professional regulations. We use electronic rather than paper records. The evolution from medieval to modern accounting has involved both continuity and change, preservation of fundamental principles, alongside adaptation to new circumstances. Understanding this history helps us see that accounting is not a timeless, natural, or inevitable practice, but a human creation, something that was invented at a particular time for particular purposes, and that continues to evolve. The choices that medieval accountants made about how to record transactions, what information to track, how to calculate profit, these were not dictated by nature, but reflected human judgments about what mattered, what needed to be known, what kind of economic reality we wanted to create. And the same is true today. Our accounting methods embody choices, values, assumptions about what is important and what can be ignored, and these choices shape the economic world we inhabit. The story of medieval accounting is ultimately a story about how human beings learned to see the economic world in a new way, to make visible patterns and relationships that had previously been hidden, to subject economic life to rational analysis and systematic control. It is a story about the power of abstraction, the way that reducing messy reality to numbers and symbols can reveal truths and enable action. It is a story about the relationship between economic practice and culture, between the requirements of business and the values of society. And it is a story that continues today as we develop new accounting methods for new challenges, as we wrestle with how to account for environmental costs and social impacts and other things that do not fit neatly into traditional financial categories. The 2 hours we have spent together exploring this topic have necessarily been selective, touching on some themes while leaving others unexplored, focusing on certain periods and places while neglecting others. There is vastly more that could be said about medieval accounting, about the Byzantine accounting traditions that influenced Italy, about Islamic accounting practices and their relationship to European developments, about accounting in medieval England and France and Germany, about the differences between accounting for agriculture versus manufacturing versus trade, about the evolution of accounting thought from the medieval to the early modern period, about the specific biographies of important accountants and the particular histories of major merchant houses. Each of these topics could sustain a lecture of its own, could be the subject of years of scholarly research. But I hope that this lecture has given you a sense of the richness and importance of medieval accounting, that it has helped you understand that this was not merely a technical development, but a cultural achievement of profound significance. The medieval merchants and accountants who created double-entry bookkeeping were doing more than solving practical business problems. They were inventing a new way of thinking about economic life, creating conceptual tools that would shape the development of capitalism and the modern world. Their account books, preserved in archives across Europe, are not just historical curiosities, but documents of a revolution in human consciousness. Records of the moment when humanity learned to see the economy with new eyes and to capture that vision in writing. And now let me tell you a story that brings all of these abstract principles to life. A story about a particular merchant in a particular time and place, whose account books have survived the centuries and whose experiences illuminate everything we have been discussing. His name was Francesco di Marco Dettini, and he lived in the Tuscan city of Prato in the late 14th and early 15th centuries. And by an extraordinary stroke of fortune, his business archive has been preserved almost intact. Some 150,000 letters and 500 account books and ledgers, creating an unparalleled window into the economic life of medieval Europe. Dettini was born around 1335 into a modest artisan family, but both his parents died in the Black Death of 1348, leaving him an orphan at 13 with a small inheritance. He used this inheritance to apprentice himself to a merchant, learning the trade, learning to read and write and calculate, learning the mysteries of bills of exchange and partnership agreements, and double-entry accounts. By the time he was 15, he had left Prato for Avignon in southern France, where the papal court had relocated, and where opportunities abounded for an ambitious young man, willing to work hard and take risks. He started small, selling the products of Tuscan craftsmen, buying goods that were plentiful in France, and shipping them back to Italy, building his capital slowly through countless small transactions. What makes Dettini's story so valuable for understanding medieval accounting is that we can follow his business in extraordinary detail, transaction by transaction, year by year, watching as he expanded from a small-scale peddler to a major international merchant with operations in multiple cities. His earliest accounts, kept when he was still learning the business, are relatively simple, using the bilateral system I described earlier, tracking what individual customers owed him and what he owed to suppliers. But as his business grew, as he entered into partnerships and established branches in different cities, his accounting methods became more sophisticated, eventually adopting the full double-entry system that was spreading through the Italian merchant community. The transition is visible in the account books themselves. In the 1360s, when Dettini was still operating mainly out of Avignon, his ledgers show him grappling with the complexity of multiple currencies, multiple business ventures, multiple partners, and you can see him experimenting with different ways of organizing the accounts, trying to find a system that would give him the control and visibility he needed. There are crossouts and corrections, marginal notes to himself, experiments with different formats and layouts. It is like watching someone learn a new language, struggling with the grammar and vocabulary, gradually becoming more fluent and confident. By the 1370s, when Dettini returned to Prato and began establishing a network of branches throughout Italy and beyond, his accounts had become models of double-entry precision. Each branch kept its own set of books, according to standardized methods, with a journal for recording transactions chronologically, and a ledger organized by accounts, with separate accounts for different types of merchandise, for different customers and suppliers, for different partners and employees, for expenses and revenues of various kinds. At regular intervals, typically annually, The branch accounts were closed, and the results sent to Prato, where Datini's head accountant would consolidate them into summary statements, showing the overall financial position of the entire enterprise. These consolidated statements reveal the complexity of Datini's operations. At any given time, he might have capital invested in a dozen different partnerships, each operating independently but all ultimately controlled by him. He had a company trading in wool and cloth, another dealing in spices and dyes, another operating as a bank accepting deposits and making loans, another running a silk manufacturing business. He owned real estate in multiple cities, ships that carried goods across the Mediterranean, warehouses stuffed with inventory, waiting for favorable market conditions. The accounting system that tracked all of this was a marvel of organization. A paper empire that mirrored the commercial empire it described. What the accounts show, when you dig into them deeply as historians have done, is not just the financial skeleton of Datini's business, but the flesh and blood of daily commercial life. You can see which products were profitable and which were not, how profit margins varied by season and by market, how long it took to convert inventory into cash, how much capital was tied up in accounts receivable at any given time. You can trace individual bales of wool from their purchase in England, through their shipment to Florence, their manufacture into cloth, their sale to customers in Barcelona or Venice, and you can see exactly how much profit was made at each stage of this journey. The accounts make visible the entire chain of value creation, from raw material to finished product to satisfied customer. But the accounts also reveal Datini's anxieties and concerns, the things that kept him awake at night despite his growing wealth. Marginal notes in his own handwriting express worry about outstanding debts, about ships that have not arrived on schedule, about partners who may not be entirely honest, about the political turmoils that constantly threaten to disrupt trade. "May God grant that Marco pays what he owes," reads one note. "I fear this venture will end badly," reads another. The accounts were not just mutual records, but emotional documents, repositories of hope and fear, trust and suspicion, all the human feelings that accompanied economic activity. One episode in particular, documented in meticulous detail in the accounts, illustrates both the power and the limitations of medieval accounting. In 1383, Datini entered into a partnership with several other merchants to trade in armor and weapons, supplying the various armies that were constantly fighting in the fractured political landscape of Italy. This was a risky business, because customers were often unreliable, because goods might be seized by rival forces, because the whole enterprise depended on wars continuing, and if peace broke out, the market would collapse. The partnership agreement, carefully recorded in the account books, specified that Datini would contribute 40% of the capital and receive 40% of the profits, with the other partners contributing and receiving proportionally. For the first year, everything went well. The accounts show steady sales, reasonable profit margins, regular dividend distributions to the partners. But in the second year, problems began to emerge. One of the traveling partners, who was responsible for selling the goods to military customers, claimed that he had been robbed on the road and that a large quantity of armor had been lost. The accounts duly recorded this loss, reducing the inventory and creating an extraordinary expense that virtually wiped out the year's profit. But Datini suspected fraud, believed that the traveling partner had in fact sold the goods and pocketed the proceeds, and was now claiming robbery to cover his tracks. How do you prove or disprove such a claim using accounting records? The loss was recorded in the books, reducing the traveling partner's share of the profits, just as it reduced everyone else's. So on the face of it, he had no motive to lie. But Datini reasoned that the traveling partner could have sold the goods privately, outside the partnership accounts, keeping all the proceeds for himself while claiming that the partnership had suffered a loss. The accounting system, for all its precision and sophistication, could only record what was reported to it. It could not prevent or detect fraud by someone who controlled the information flow. Datini demanded an investigation, insisted on seeing the traveling partner's personal accounts, hired informants to ask questions in the cities where the robbery supposedly occurred. The dispute dragged on for months, poisoning relationships among the partners, and eventually leading to the dissolution of the partnership. The final accounting, when the partnership was liquidated and the assets distributed, was a nightmare of accusations and counter-accusations, with each partner claiming that the others owed money or had taken more than their fair share. The written accounts, which should have provided an objective record of what had transpired, became weapons in a battle where each side interpreted the same numbers differently. This episode taught Datini an important lesson about the limits of accounting as a tool for preventing fraud and ensuring honesty. No matter how sophisticated the bookkeeping system, it ultimately depended on the integrity of the people who fed information into it. A dishonest partner could manipulate the accounts, could create fictitious expenses, or hide revenues, and unless you had independent verification, you might never know. From this point forward, Dettini was much more careful about choosing partners, much more insistent on regular audits and cross-checks, much more likely to insert clauses in partnership agreements requiring partners to open their personal accounts for inspection if disputes arose. But Dettini's story also shows the positive power of good accounting, the way that reliable financial information enabled business success. In 1394, Dettini decided to establish a branch in Valencia, Spain, to trade in the lucrative Mediterranean Atlantic exchange, buying Spanish wool and exporting it to Italy while importing Italian manufactured goods for the Spanish market. This was a major undertaking, requiring substantial capital, careful planning, and meticulous execution. The account books show Dettini preparing for this venture with the care of a general planning and military campaign. First, he analyzed his existing accounts to determine how much capital he could safely commit to the new venture without endangering his other operations. He had learned from bitter experience that overextension was dangerous, that tying up too much capital in illiquid assets could leave you unable to meet unexpected obligations. The accounts showed him exactly how much cash he had on hand, how much was tied up in inventory and receivables, how much he owed to creditors and depositors, and from this information he calculated that he could safely invest 10,000 florins in the Valencia branch. Second, he used his accounting records to identify which products had been most profitable in the past, and which markets had been most receptive to Italian goods. He discovered, by analyzing years of transaction data, that Spanish customers were particularly interested in high-quality silks and woolens, that they paid premium prices for fine craftsmanship, and that they were less price-sensitive than customers in some other markets. This information shaped his product strategy for the Valencia branch, leading him to focus on luxury goods rather than trying to compete in the mass market for cheaper fabrics. Third, he established a rigorous reporting system for the Valencia branch, requiring the manager there to send detailed accounts to Prato every quarter, showing all transactions, all changes in inventory, all outstanding debts and obligations. These reports were cross-checked against the correspondence between the branches, against customs records showing what goods had been shipped, against bills of exchange that had been issued or paid. Any discrepancy triggered an immediate inquiry, a demand for explanation and documentation. This system created transparency and accountability, making it very difficult for the Valencia manager to defraud the company, even if he had been so inclined. The Valencia branch was a great success, generating substantial profits year after year, and Dettini attributed this success in large part to the quality of his accounting system. He could see immediately which products were selling and which were sitting in the warehouse, which customers were paying promptly and which were falling behind, which seasons were profitable and which required special promotions or price adjustments. This information allowed him to make intelligent decisions, to adjust quickly to changing conditions, to avoid costly mistakes. The accounts were not just records of the past, but tools for managing the present and planning the future. As Dettini aged, he became increasingly preoccupied with the question of what would happen to his wealth after his death. He had no legitimate children, though he had maintained a decades-long relationship with a slave woman who had borne him a daughter, and under the laws of the time, this daughter could not inherit. He had accumulated enormous wealth, by some estimates over 100,000 florins, making him one of the richest men in Tuscany, and he worried constantly about how this wealth should be distributed. His wife Margherita, with whom he had a long and often contentious marriage, documented in hundreds of surviving letters, would receive a widow's portion, but the bulk of the estate needed to go somewhere else. Dettini's solution was to create a charitable foundation, the Ceppo dei Pioveri di Francesco di Marco, which would use the income from his estate to support the poor of Prato in perpetuity. This was a common enough arrangement among wealthy medieval merchants, a way of securing salvation through posthumous charity, while also creating a lasting monument to one's name. But what made Dettini's foundation unusual was the meticulous attention he paid to its financial structure, to ensuring that the accounting systems would be adequate to manage the endowment honestly and effectively long after his death. His will, which is preserved along with his other papers, contains detailed instructions about how the foundation's accounts should be kept. There must be a ledger recording all properties and revenues, another book tracking all expenditures on poor relief, annual audits by independent accountants appointed by the city government, public posting of financial statements so that citizens could verify that the foundation was fulfilling its mission. These requirements reflected Dettini's deep understanding of accounting and his recognition that even well-intentioned institutions could become corrupt without proper financial controls and transparency. Dettini died in 1410, and his foundation was duly established according to his wishes. The accounting records of the foundation survive and show that his instructions were followed faithfully, that the endowment was managed prudently, that thousands of poor people received assistance over the succeeding centuries. The foundation still exists today, more than 600 years later, still using the basic accounting principles that Datini specified in his will, still distributing aid to the needy, still maintaining the meticulous records that its founder believed were essential to honest stewardship. But perhaps the greatest legacy of Datini's obsessive record-keeping is the archive itself. That vast collection of papers that he preserved and that by some miracle was not destroyed in the wars and upheavals of subsequent centuries. In the 1860s, this archive was discovered in a forgotten room in Datini's old house in Prato, trunks and chests full of documents that had been sealed up and left undisturbed for more than 400 years. When scholars began to examine these papers, they realized that they had found something extraordinary, a complete documentary record of a medieval merchant's life and business, unprecedented in its scope and detail. The archive has been studied intensively by historians ever since, generating hundreds of books and articles, dissertations and monographs, each mining these rich materials for new insights into medieval economic, social, and cultural history. We know things about daily life in the 14th century, about prices and wages and living conditions, about business practices and family relationships and religious attitudes that we could never know from any other source, all because one merchant kept compulsive records and had the foresight to preserve them. The account books in particular have been invaluable for understanding the development of medieval accounting, providing concrete examples of techniques and methods that are only vaguely described in theoretical treatises. But studying Datini's papers also reveals the human being behind the accounts. The man who worried and schemed and loved and feared, who was generous to the poor but harsh with debtors, who maintained elaborate business relationships across Europe, but also feuded bitterly with neighbors over trivial slights, who built a fortune through intelligence and hard work, but could never quite shake the insecurity of the orphan who had lost everything in childhood. The accounts were a tool for managing his business, but they were also perhaps a way of imposing order on a chaotic world, of creating certainty and predictability in a life that had taught him how quickly everything could be taken away. There is something profoundly moving about reading Datini's letters to his wife, many of which contain references to the accounts or the books, treating financial matters and personal matters in the same breath, as if they were all part of one continuous reality. "I have received your letter," he writes in 1395, "and I am glad to hear that you are well. The books show that the wool venture has turned a small profit, thanks be to God. Please remember to pay Guido what we owe him, and tell him that I will send the cloth he ordered by the next courier. I miss you, and think of you often." The accounts were woven into the fabric of his relationships, a language he shared with his wife and partners, a way of communicating about what mattered to him. In one particularly poignant letter from 1399, Datini writes to Margherita about his plans for the charitable foundation that would eventually bear his name. "I want to leave something good behind," he tells her, "something that will help people after I am gone." The accounts show that we have more than we need, more than we can possibly spend in the years remaining to us. What is the point of accumulating wealth if it does not serve some purpose beyond our own comfort? I have been thinking about the poor, about people who have nothing, and I want to use what God has given me to help them. And then, characteristically, he adds, but it must be done properly, with good accounts and honest managers, so that the money actually reaches those who need it and is not stolen by corrupt officials. This concern for proper accounting, for honest stewardship, for using wealth wisely and accountably runs through everything Datini wrote and did. He was not a saint. His business practices were sometimes ruthless. He charged high interest rates disguised as exchange fees. He took advantage of others' misfortunes to buy low and sell high. He was by most accounts difficult to live with and quick to anger. But he also believed deeply in certain principles. That honesty mattered, that accounts should reflect truth, that wealth brought responsibilities as well as privileges, that good records were essential to good management. These beliefs shaped his accounting practices, and his accounting practices in turn shaped how he understood himself and his place in the world. Consider what his account books reveal about his attitude toward risk and uncertainty. Two concepts that are central to economic life, but difficult to capture in numerical form. Medieval merchants faced enormous uncertainties. Ships sank in storms. Wars disrupted trade routes. Currencies fluctuated wildly. Customers defaulted on debts. Political upheavals could destroy a lifetime's accumulation of wealth overnight. How do you account for risk? How do you incorporate uncertainty into your financial planning? Datini's approach, visible in his accounting practices, was to be conservative in his valuations, to maintain substantial reserves, to diversify his investments across multiple ventures and multiple markets. His accounts consistently valued assets at the lower end of their probable market value, recognizing losses promptly, but deferring the recognition of gains until they were certain. He set aside reserves for bad debts that were larger than historical experience would have suggested, necessary, preferring to be pleasantly surprised by collections rather than disappointed by defaults. He kept a substantial portion of his wealth in cash or liquid securities, even though this meant foregoing higher returns that could be earned by investing more aggressively. These practices, documented meticulously in his account books, represented a philosophy of risk management that was sophisticated for its time. Dattini understood that the purpose of business was not to maximize profit in any single transaction or venture, but to preserve and grow capital over the long term. That sustainable success required prudence and caution as much as boldness and ambition. The accounts were tools for implementing this philosophy, for monitoring whether he was staying within acceptable risk parameters, for ensuring that one bad venture could not bring down the entire enterprise. The accounts also reveal Dattini's relationships with his employees and partners, showing how he used financial incentives to motivate performance and ensure loyalty. His managers in branch offices received salaries, recorded in the wage accounts, but they also received shares of branch profits, creating an alignment of interests between manager and owner. The profit-sharing percentages were carefully calculated and documented, adjusted based on the manager's level of responsibility and the profitability of the branch, reviewed and renegotiated periodically. This was sophisticated human resource management, using accounting information to design compensation systems that encouraged desired behaviors. Similarly, Dattini's dealings with his partners show a keen awareness of how accounting could build trust or destroy it. When forming a new partnership, he insisted on clear written agreements specifying exactly how profits and losses would be divided, how capital contributions would be valued, how disputes would be resolved. The partnership accounts were kept separate from his personal accounts, maintaining a clear distinction between what belonged to the partnership and what belonged to him individually. Periodic statements were prepared, showing each partner's current account balance, what they had contributed and what they had withdrawn, ensuring transparency and preventing misunderstandings. But accounting could also be weaponized in disputes, and Dattini was not above using his superior understanding of accounts to gain advantage over less sophisticated partners. In one case, documented in a long series of letters, Dattini disputed a partner's interpretation of how certain expenses should be allocated between two joint ventures. The partner argued that certain costs were specific to one venture and should be charged entirely to that account, while Dattini maintained that they were shared costs that should be split proportionally. The technical accounting question masked a substantive disagreement about money, about who owed what to whom, and Dattini used his expertise to frame the question in ways that favored his interpretation. The resolution of this dispute reveals something important about the limits of accounting as a tool for resolving conflicts. Eventually, the partners submitted their disagreement to arbitration by a panel of respected merchants who examined the accounts and rendered a judgment. The arbitrators found in Dattini's favor on some points and against him on others, essentially splitting the difference between the two positions. The accounting records provided evidence for the arbitration, but they could not determine the outcome by themselves. Judgment and interpretation were still required, decisions about what was fair and reasonable that went beyond the numbers themselves. As Dattini's business grew larger and more complex, he faced increasing challenges in maintaining control and oversight. He could not personally review every transaction in every branch, could not examine every page of every ledger. He had to rely on his accountants and managers, had to trust that they were following his instructions and representing the financial situation accurately. This delegation was necessary for the business to function, but it also created vulnerabilities, opportunities for fraud or incompetence to go undetected. Dattini's solution was to create multiple overlapping systems of verification and control. Branch accounts were reviewed by the head office accountant, but they were also subject to periodic inspections by Dattini himself or by trusted representatives who would travel to the branch unannounced and conduct surprise audits. Correspondence between branches was routed through the head office, allowing Dattini to monitor what his managers were doing and saying. Large transactions required approval from Prato before being executed. Cash balances were verified through independent counts. These controls were burdensome and sometimes irritated his managers, who felt they were not trusted, but Dattini believed they were necessary to protect against the inevitable human tendencies toward laziness, dishonesty, and self-interest. The cost of maintaining these control systems were substantial, both in terms of the salaries paid to accountants and auditors, and in terms of the time and attention that Dattini himself had to devote to reviewing accounts and investigating discrepancies. But he viewed these costs as worthwhile, as insurance against much larger losses that could result from poor control. The accounts themselves documented these control costs, showing them as a significant category of overhead expense, and Dattini periodically reviewed whether the benefits justified the costs, whether he was spending too much or too little on financial management. In his later years, as his health declined and he began to think seriously about succession, Dattini became concerned about whether the accounting systems he had built would survive his death, whether his successors would have the knowledge and commitment to maintain them. He began training his nephew, who would eventually manage the business, in accounting principles and practices, walking him through the ledgers and journals, explaining the logic behind different accounts and procedures, sharing the hard-won wisdom of 4 decades in commerce. These training sessions, mentioned in letters and reflected in marginal notes in the account books, represent an attempt to codify and transmit tacit knowledge, to turn personal expertise into organizational capability. But Dottini also recognized that no individual could fully replace him, that his deep understanding of the business came from years of intimate involvement in every aspect of operations. His solution was to rely increasingly on written procedures and policies, on documenting how things should be done, so that future managers could follow established practices, even if they did not fully understand the reasoning behind them. The account books themselves became instructional manuals, with notes explaining why certain accounts existed, how certain calculations should be performed, what to do in various contingencies. This documentation was itself a form of accounting, an attempt to create a written record, not just of what had happened, but of how things should happen. When Dottini finally died in 1410, at the age of 75, his estate was valued at over 100,000 florins, making him one of the wealthiest men in Tuscany. The inventory of his possessions, compiled by the executors of his will and preserved in the archive, shows the fruits of a lifetime of careful accounting and prudent management. Houses and land in multiple cities, warehouses full of valuable merchandise, loans and bills of exchange representing claims against dozens of debtors, partnership shares in thriving businesses, cash and precious metals, furnishings and artworks, the physical embodiment of numbers that had been accumulating in ledgers for decades. The executors used the account books to verify the inventory, to ensure that every asset had been identified and valued, to determine what was owed to creditors and what could be distributed to beneficiaries. The settlement of Dottini's estate took several years and generated reams of additional accounting records, as executors traced obligations, collected debts, liquidated partnerships, transferred properties. These records show the account books functioning as they were designed to function, providing a complete and accurate picture of the deceased's financial position, enabling the orderly transfer of wealth according to his wishes. Without those meticulously maintained accounts, the settlement would have been far more difficult, probably impossible, with beneficiaries fighting over uncertain assets and creditors struggling to prove what they were owed. The charitable foundation that Dottini established has maintained continuous operations from 1410 to the present day, making it one of the oldest continuously operating charitable institutions in Europe. Throughout its long history, it has kept detailed accounts following the principles that Dottini specified in his will, creating an unbroken record of financial stewardship spanning more than 6 centuries. Historians have studied these foundation accounts, tracing how the endowment was managed through wars and plagues and economic upheavals, through the decline of medieval commerce and the rise of modern industry, through inflation and deflation and technological change. The continuity of the accounting system has enabled this continuity of operations, providing stability and predictability in a constantly changing world. And so, we see in Francesco Dottini's life and legacy a powerful illustration of everything we have been discussing in this lecture. The practical importance of good accounting for business success, the role of accounts in managing risk and building trust, the ways that accounting both enables and constrains organizational action, the personal and cultural dimensions of what might seem like purely technical practices, the enduring relevance of medieval innovations that continue to shape our economic life today. Dottini was not a theorist or innovator in accounting. He did not invent double-entry bookkeeping or write treatises explaining its principles. He was a practitioner, a merchant who used accounting tools that others had developed, adapting them to his particular needs and circumstances, but his surviving papers allow us to see those tools in action with a clarity and detail that no theoretical treatise could provide. His account books are a monument to the power of systematic record-keeping, to the insights that can be gained from careful attention to financial detail, to the possibility of capturing economic reality in written form and using that captured reality to guide action in the world. And in this sense, Francesco di Marco Dottini, merchant of Prato, stands as the embodiment of medieval accounting, showing us both its technical sophistication and its human dimensions, both its practical utility and its deeper significance for understanding how people thought about wealth and value and obligation in a world very different from, but also surprisingly similar to our own. And yet there is another story, equally illuminating and perhaps even more dramatic, that deserves our attention. A tale that takes us from the counting houses of Florence to the spice markets of Alexandria, from the banking halls of Bruges to the Silk Roads of Central Asia. A story about a merchant family whose accounting practices were so advanced, so sophisticated, so carefully documented that they allow us to peer into the very heart of medieval commercial civilization and see how it actually worked, not in theory, but in the messy, complicated, endlessly fascinating reality of daily business life. This is the story of the Alberti family of Florence, and more particularly of the Alberti Company's operations in the early 15th century, when they were among the largest and most powerful merchant banking houses in Europe. With tentacles reaching into every corner of the known world and account books that tracked a dizzying array of transactions across dozens of currencies, hundreds of partnerships, thousands of individual deals. The Alberti were an old Florentine family, members of the city's patrician elite, with roots going back to the early days of the Commune, when Florence was just beginning its transformation from a modest provincial town to one of the great commercial and cultural centers of Europe. By the 14th century, the Alberti had branched into multiple distinct family lines, some focusing on politics and public service, others on scholarship and the arts, but the branch that concerns us devoted itself primarily to commerce, building a trading and banking empire that rivaled the better-known Medici in scope and sophistication. What makes the Alberti especially valuable for our purposes is that their account books have survived in remarkable completeness for certain crucial years, and these books reveal accounting practices that pushed the boundaries of what was possible in the medieval period, experimenting with techniques and approaches that would not become standard for centuries. The head of the Alberti Company in the early 1420s was a man named Benedetto di Nerozzo Alberti, and he faced challenges that would have overwhelmed a lesser manager. The company operated branches in 14 cities across Europe and the Mediterranean: Florence, Rome, Venice, Genoa, Barcelona, Valencia, Bruges, London, Rhodes, Constantinople, Alexandria, Damascus, and others that came and went as opportunities appeared and disappeared. Each branch engaged in both trade and banking, buying and selling goods, one also accepting deposits, making loans and dealing in bills of exchange. The complexity was staggering, with hundreds of transactions occurring every day, with partnerships forming and dissolving, with ships departing and arriving, with payments being made and received in dozens of different currencies, and all of this had to be tracked, recorded, consolidated, and understood if the company was to remain profitable and solvent. Benedetto's solution to this challenge was to create what we might call a proto-modern accounting system, with standardized procedures that all branches followed, with regular reporting requirements, with consolidation methods that allowed the head office in Florence to see the big picture, even as individual branches focused on their local operations. The system was documented in a manual, a sort of company accounting policy handbook, copies of which were sent to each branch manager with strict instructions that it must be followed exactly. This manual, which survives in the Alberti archives, is itself a remarkable document, showing a level of organizational sophistication that we typically associate with much later periods of business history. The manual specified exactly what accounts each branch must maintain: a cash account tracking all money received and paid out, separate accounts for each major category of merchandise inventory, accounts for bills of exchange both receivable and payable, accounts for each partner's capital contribution and share of profits, accounts for major customers and suppliers, expense accounts broken down by category, and many others. It specified the format for journal entries, requiring a date, a description of the transaction, the names of the parties involved, the amount in both local currency and Florentine florins for comparison purposes, and cross-references to related entries in other accounts. It required that all entries be made in permanent ink, that no erasures be permitted, that any corrections be made by crossing out the original entry and writing a new one with a note explaining the change, that pages be numbered sequentially to prevent insertion or removal of records. The manual also established a reporting cycle, requiring each branch to close its books at the end of each quarter and send a complete set of financial statements to Florence within 30 days. These statements included what we would recognize as a balance sheet, showing all assets and liabilities, and an income statement, showing revenues and expenses and the resulting profit or loss, along with supporting schedules, providing detail on major account categories. The requirement for quarterly reporting was remarkable for the time. Most medieval merchants closed their books annually, if at all, and the discipline of quarterly closing forced branch managers to stay on top of their accounting, to reconcile discrepancies promptly, to maintain accurate and current records. But perhaps the most innovative aspect of the Alberti accounting system was its approach to consolidation, to combining the financial results of all the branches into a unified picture of the entire company's financial position. This was enormously challenging, given the geographic dispersion of the branches, the different currencies they operated in, the different business conditions they faced, the time lags in communication that meant information from distant branches might be months out of date by the time it reached Florence. Benedetto developed a multi-stage consolidation process that first converted all figures to Florentine florins using standardized exchange rates, then combined branches within the same region into regional subtotals, then aggregated the regional figures into a company-wide total, with each stage carefully documented and cross-checked to ensure accuracy. The consolidated financial statements that resulted from this process were themselves works of art, beautifully written documents with elegant calligraphy and precisely ruled columns, showing the Alberti company's complete financial position as of the end of each quarter. These statements revealed things that would have been impossible to see from the individual branch reports. They showed which regions were most profitable and which were struggling, which product lines generated the best returns, how much capital was tied up in inventory versus receivables versus cash, what the company's overall leverage ratio was, whether the company was growing or contracting. Armed with this information, Benedetto could make strategic decisions about where to allocate resources, which branches to expand and which to close, which partnerships to renew and which to let lapse, which markets to enter and which to exit. Let me give you a specific example to show how this accounting system worked in practice and what it revealed. In the third quarter of 1421, the Alberti branch in Alexandria reported a substantial profit from trading in pepper and other spices purchased in the markets of Egypt and the Red Sea region and shipped to Europe for resale. The Alexandria accounts showed the purchase of 10,000 pounds of pepper at an average cost of 4 silver dirhams per pound. Total cost 40,000 dirhams, or approximately 8,000 florins at the prevailing exchange rate. The pepper was shipped to Venice, where the branch there reported receiving it and selling it for 12,000 florins, a gross profit of 4,000 florins or 50% return on cost. This looked like an excellent result, and the Alexandria and Venice branch managers proudly highlighted it in their quarterly reports. But when Benedetto's accountants in Florence consolidated these figures with reports from other branches, a more complex picture emerged. The pepper had been transported on Alberti ships, and the shipping costs, recorded in the accounts of the company's maritime division, amounted to 1,200 florins. Insurance premiums to cover the risk of loss at sea added another 400 florins. Customs duties and port fees at both Alexandria and Venice totaled 600 florins. The Venice branch had to warehouse the pepper for 3 months before finding buyers, and the warehouse rental and handling costs were 200 florins. Sales commissions to the brokers who found customers amounted to 600 florins, 5% of the sales price. When all these costs were properly allocated, the net profit on the transaction was not 4,000 florins, but only 1,000 florins, still a respectable 12.5% return, but far less impressive than the initial figures suggested. Moreover, the consolidated accounts revealed that this profit came at the cost of substantial capital commitment over an extended period. The pepper was purchased in June 1421, but not fully sold until November, a 5-month cycle. During this time, 8,000 florins of capital was tied up in inventory and in transit, capital that could not be used for other purposes. When you calculated the annualized return on capital, accounting for the time value of money, the 1,000 florin profit on 8,000 florins invested for 5 months worked out to an annual return of about 30%. Which was good, but not exceptional compared to some of the company's other ventures. The accounting system made these calculations possible, revealing the true profitability of different business lines and enabling rational allocation of the company's limited capital resources. The Alexandria pepper trade also illustrated another crucial function of the Alberti accounting system: risk management and the quantification of uncertainty. Medieval trade was inherently risky, as I have mentioned before, with ships sinking, goods spoiling, customers defaulting, wars disrupting routes, and countless other potential disasters. The Alberti accountants developed sophisticated methods for tracking and analyzing these risks, creating what we might call an early form of risk-adjusted accounting. They maintained separate accounts for insurance expenses, for losses from bad debts, for write-downs of damaged or obsolete inventory, and they tracked these losses by branch, by product line, by customer category, looking for patterns that could inform future decisions. The accounts showed, for example, that shipments to Alexandria had a higher loss rate than shipments to most other destinations. About 8% of voyages resulted in total or partial loss, compared to a company-wide average of 5%. This information was used to adjust insurance coverage for Alexandria trade, to build larger risk premiums into pricing decisions, and eventually to shift some of the company's eastern trade to alternative routes through the Black Sea that appeared to be safer. The accounting data drove strategic business decisions, demonstrating the practical value of careful record-keeping and systematic analysis. But the Alberti accounts reveal much more than just trading profits and losses. They provide an extraordinarily detailed picture of how a major medieval merchant banking house actually functioned as a financial institution. The company accepted deposits from wealthy Florentines and from institutional clients like monasteries and charitable foundations, paying interest on these deposits, though the interest was carefully disguised as profit sharing to avoid accusations of usury. The deposits were recorded in accounts showing each depositor's balance, the rate of return promised, the dates when interest payments were due, and the total amount of deposits outstanding at any given time. These deposit accounts were a crucial source of capital for the Alberti company, allowing them to fund their trading and lending operations with other people's money, rather than only their own equity. But they also created a risk, because depositors could demand their money back on short notice, while the company's assets were often tied up in illiquid investments like inventory or long-term loans. The accounting system helped manage this liquidity risk by tracking the maturity structure of both assets and liabilities, showing how much was due to depositors in the next month versus the next quarter versus longer periods, and matching this against how much cash the company expected to receive from maturing assets over the same timeframes. In early 1422, the consolidated accounts revealed a potential liquidity crisis. A large depositor, a wealthy Florentine widow who had placed 20,000 florins with the Alberti company, informed them that she needed to withdraw her funds to pay for her daughter's dowry. The accounts showed that the company did not have 20,000 florins in cash readily available. Much of their capital was committed to long-term ventures that could not easily be liquidated. Benedetto had to scramble to raise cash, calling in loans from customers, selling inventory at discount prices, even borrowing from other banking houses to meet the withdrawal demand. The experience was harrowing and expensive, and it led to a fundamental rethinking of the company's liquidity management practices. After this near disaster, Benedetto instituted new accounting policies, requiring the company to maintain a minimum cash reserve equal to at least 20% of total deposits, to diversify deposit maturities so that not too much came due at any one time, and to invest a larger portion of assets in liquid securities that could be quickly converted to cash if needed. These policies were documented in updated accounting manuals sent to all branches, and compliance was monitored through the quarterly consolidated financial statements. The accounts themselves thus became not just a record of what had happened, but a tool for implementing and enforcing risk management policies, for ensuring that the painful lessons of the liquidity crisis would not be forgotten. The lending side of the Alberti banking business was equally complex and equally dependent on sophisticated accounting. The company made loans of various types: commercial loans to merchants financing their trading ventures, personal loans to nobles and wealthy individuals, loans to governments and municipalities, loans secured by real estate or other collateral, and unsecured loans based purely on the borrower's reputation and creditworthiness. Each loan had its own terms regarding interest rate, though again this was disguised as something else to avoid usury prohibitions, repayment schedule, collateral if any, and penalties for late payment. The accounting system tracked all of these details in individual loan accounts, with entries recording the original advance of funds, subsequent interest accruals, payments received, and the outstanding balance at any time. But the Alberti accountants went beyond simple record keeping to create analytical tools that helped them assess the quality of their loan portfolio and identify potential problems before they became crises. They developed a classification system that rated each loan as sound, questionable, or doubtful, based on the borrower's payment history, financial condition, and the adequacy of any collateral. Loans in the doubtful category were subject to special monitoring, with more frequent contact with the borrower and earlier intervention if problems appeared. The accounts also tracked low losses, both actual losses from borrowers who defaulted completely and partial losses from loans that were settled for less than the full amount owed. This historical loss data was used to establish reserve accounts, setting aside a portion of interest income to cover anticipated future losses. The reserve calculations were quite sophisticated, with different reserve percentages applied to different categories of loans based on their risk ratings. Sound loans might require only a 2% reserve, while questionable loans required 10%, and doubtful loans required 50%, or even full reserves. These reserves reduced reported profits in the short term, but provided a cushion that protected the company's capital when inevitable losses occurred. One particularly interesting aspect of the Alberti loan accounting was how it handled loans to governments and powerful nobles, which were both potentially very profitable and extremely risky. These borrowers often wanted large sums, far more than any individual merchant house could safely lend, and they sometimes had a cavalier attitude about repayment, believing that their political power gave them leverage over their creditors. The Alberti dealt with these challenges by forming syndicates, groups of merchant banks that would collectively fund large loans, each taking a share proportional to their contribution. The accounting for these syndicated loans was complex, requiring coordination between multiple institutions, agreement on how interest and principal payments would be divided, and mechanisms for handling situations where one syndicate member wanted to exit while others wished to continue. The Alberti accounts from 1423 document one such syndicated loan that went spectacularly wrong, providing a cautionary tale about the limits of accounting as a risk management tool. The loan was to the Duke of Milan, who needed funds to finance his ongoing wars against Venice and other rivals. The Alberti joined with several other Florentine banks to lend the Duke 100,000 florins, with the Alberti taking a 30% share or 30,000 florins. The loan was secured by the Duke's promise to repay from tax revenues and by the pledge of certain customs duties as collateral, and it bore an effective interest rate of about 15% per year, though this was structured as a currency exchange transaction to satisfy usury prohibitions. The accounting records show the loan being made in January 1423. With the 30,000 florins advanced from the Alberti company's cash accounts and a new asset account created to track the receivable from the Duke. For the first few months, everything proceeded as expected, with the Duke making interest payments on schedule and the Alberti accountants recording these payments and reducing the outstanding balance accordingly. But in June 1423, the Duke suddenly stopped paying, claiming that military expenses had exhausted his treasury and that he needed to suspend debt service until his financial situation improved. The Alberti accounts duly noted this development, reclassifying the loan from sound to doubtful and increasing the reserve against it to 50% of the outstanding balance. As months passed with no payment, the situation deteriorated further. The other members of the lending syndicate began arguing among themselves about what to do, with some wanting to seize the pledged customs revenues, while others feared that aggressive action might provoke the Duke to retaliate against Florentine merchants operating in his territories. The Alberti accounts tracked these debates through a series of entries in the syndicate account, recording meetings attended, proposals made, votes taken, always trying to maintain an accurate picture of where things stood, even as the situation became increasingly confused and contentious. By early 1424, it had become clear that the Duke had no intention of repaying the loan in the foreseeable future, and the syndicate members reluctantly wrote off their losses. The Alberti accounts show this write-off as a debit to the loan loss reserve account and a credit to the Duke of Milan receivable account, reducing the receivable to zero. The 30,000 florin loss was catastrophic, wiping out more than a year's worth of profits from the company's other operations and forcing Benedetto to explain to his partners and depositors how such a disaster had occurred. The accounting records became crucial in this process, providing a detailed chronology of events, showing that proper procedures had been followed in making the loan, that reasonable reserves had been established when problems first appeared, that the loss was the result of the Duke's bad faith rather than incompetence or negligence by Alberti management. This episode highlights an important truth about accounting that sometimes gets lost in discussions of techniques and procedures. Accounting can help you measure and manage risk, but it cannot eliminate risk, cannot protect you against determined fraud or political upheaval or simple bad luck. The Alberti had excellent accounting systems, far better than most of their contemporaries, but they still suffered massive losses from bad loans and failed ventures. What the accounting did provide was visibility, the ability to see problems as they emerged, to learn from mistakes to make informed decisions, even in difficult circumstances. And it provided accountability, a record that could be examined by partners and creditors and regulators to determine what had happened and whether those responsible had acted appropriately. The Alberti accounting system also reveals fascinating details about the company's internal organization and the relationships among its various partners and employees. The company was not owned by a single individual, but by a group of partners from different branches of the Alberti family, each of whom had contributed capital and received a share of profits proportional to their investment. The partnership accounts tracked each partner's capital balance, showing contributions made, profits earned, withdrawals taken, and the current balance. These accounts were updated quarterly based on the consolidated profit figures, with each partner's share of the total profit credited to their account. But the partnership was not simply a passive investment for these partners. Many of them were actively involved in managing different aspects of the business, and the accounting had to reflect this complex mix of ownership and management. Some partners managed specific branches, receiving both a salary for their work, recorded in the wage expense accounts, and a share of branch profits beyond their ownership percentage, recorded as a bonus or incentive payment. Other partners had oversight responsibilities for particular product lines or regions, again receiving compensation that mixed salary and profit sharing. The accounting system had to track all of this, ensuring that each partner received what they were entitled to, while also maintaining fairness and transparency that preserved family harmony. The potential for conflict was enormous, as different partners had different interests and priorities, and the accounting records show numerous disputes over how profits should be calculated and distributed, how expenses should be allocated between branches or partners, how losses should be shared, whether certain expenditures were legitimate business expenses or personal benefits that should be charged to individual partners. These disputes were mediated through the accounting system, with partners presenting their cases based on the numbers in the books, arguing about the proper interpretation of accounting policies. sometimes demanding independent audits to verify that they were being treated fairly. One particularly bitter dispute in 1425 involved the allocation of shipping costs between the trading operations, which needed ships to transport goods, and the banking operations, which sometimes used ships to transport cash and precious metals. The trading partners argued that banking should pay a larger share of shipping costs because banking cargo was more valuable per unit of weight and therefore more expensive to insure and protect. The banking partners countered that trading generated much higher shipping volumes and therefore should bear proportionally more of the fixed costs of maintaining a fleet. The accounting records contain lengthy memos from both sides, with detailed calculations supporting their respective positions, with references to historical cost allocations and comparisons to practices at other merchant houses. Eventually, the partners agreed to submit the dispute to arbitration by a panel of respected Florentine merchants who would examine the accounts and render a judgment. The arbitrators spend weeks reviewing the Alberti books, tracing individual transactions, interviewing ship captains and warehouse managers, trying to understand the actual pattern of ship usage and the real drivers of shipping costs. Their final ruling split the difference, establishing a formula that allocated shipping costs based partly on cargo value and partly on cargo volume, with specific percentages derived from the historical data in the accounts. This formula was then incorporated into the accounting manual as official company policy, to be applied consistently going forward unless changed by unanimous agreement of all partners. This episode illustrates how accounting served not just as a management tool, but as a mechanism for governance, for resolving conflicts and making collective decisions in a business with multiple owners. The accounts were a shared reality that all partners had to accept, a common ground for discussion, even when interests diverged. Without reliable accounts, the partnership would probably have disintegrated into acrimony and litigation, with each partner pursuing their own interests at the expense of the collective enterprise. The accounting held them together, enforcing a discipline of transparency and reasoned argument that made cooperation possible. The Alberti accounts also provide remarkable insights into the company's relationships with its employees, revealing both the sophisticated human resource practices and the sometimes harsh realities of working in a medieval merchant house. The company employed dozens of people, accountants and clerks who kept the books, factors and agents who bought and sold goods, messengers who carried correspondence and money between branches, warehouse workers who handled and stored merchandise, ship captains and sailors who transported goods by sea, guards who protected valuable cargo. Each of these employees had an account showing their wages, bonuses, and any advances or debts. The wage accounts reveal interesting patterns and hierarchies. Senior accountants in major branches like Florence or Venice earned substantial salaries, 200 to 300 florins per year, while junior clerks might earn only 30 or 40 florins. Factors operating in distant markets commanded premium wages, reflecting both their skills and the hardships of their assignments. A factor in Alexandria might earn 250 florins plus a share of trading profits, while a factor in the more comfortable environment of Bruges earned less. These wage differentials were carefully calibrated to attract and retain talented people, and the accounting records show Benedetto regularly reviewing wage levels and making adjustments to remain competitive with other merchant houses. But the accounts also show a darker side of medieval employment, the use of wage garnishment and debt bondage to control workers. Many employees were perpetually in debt to the company, having borrowed money for personal expenses or family emergencies, and these debts were deducted from their wages at rates that made it difficult or impossible ever to repay the principal. A clerk earning 50 florins per year might owe 100 florins to the company, with interest accruing at 10% per year and only 20 florins per year being deducted from wages, meaning the debt would grow rather than shrink. This debt bondage kept employees tied to the company, unable to leave even if they wanted to, because they could not settle their obligations. The accounting records document several cases of employees who tried to flee, abandoning their positions and disappearing to escape their debts. When this happened, the company would write off the employee's outstanding debt as a loss, recording it in the bad debt expense account, but they would also circulate the employee's name and description to other Alberti branches and to associated merchant houses, essentially blacklisting them and making it very difficult for them to find work elsewhere in the merchant community. The accounts thus served as tools of social control, maintaining power relationships and enforcing discipline in ways that modern sensibilities would find troubling. Yet the accounts also reveal moments of generosity and compassion, suggesting that the reality was more nuanced than simple exploitation. There are entries recording gifts to employees for weddings or births, advances made without interest to help with family medical expenses, bonuses paid for exceptional service, pensions granted to retired employees who could no longer work. One particularly poignant entry from 1424 records a payment of 50 florins to the widow of an accountant who had died suddenly, described as a gift in recognition of Antonio's 20 years of faithful service, and to help his family in this time of sorrow. These payments were not required by any contract or law, but represented a recognition of human relationships that went beyond purely economic calculations. The treatment of apprentices in the Alberti accounts is especially interesting because it reveals how accounting knowledge was transmitted from one generation to the next. The company regularly took on young men, usually relatives or sons of business associates, as apprentices who would learn the merchant trade by working in various capacities over several years. These apprentices typically received no wages in the first year or two, but were given room and board, their expenses recorded in special accounts. As they gained skills and experience, they would begin receiving small wages and taking on more responsibility, with their progression tracked in the accounting records. The accounts show a structured program of rotation, with apprentices spending time in different departments and different branches to gain broad exposure to all aspects of the business. An apprentice might spend 6 months in the warehouse learning about different types of merchandise, then 6 months in the accounting office learning bookkeeping, then a year in a foreign branch learning languages and commercial practices in other markets. Then back to Florence for more advanced training in finance and partnership management. This rotation was carefully planned and documented, with each apprentice having a development plan that specified what they should learn and when, and with regular assessments of their progress recorded in the accounts. The most promising apprentices would eventually be offered junior partnerships, contributing a small amount of capital and receiving a small share of profits, with the expectation that over time their partnership share would grow as they demonstrated capability and commitment. The accounting records track these transitions, showing young men moving from the wage expense accounts to the partner capital accounts, their status in the organization changing as their role evolved. This created a pathway for talented individuals to rise through the organization based on merit, though in practice, family connections still mattered enormously, and sons of existing partners had significant advantages over outsiders. Let me turn now to another fascinating dimension of the Alberti account: their treatment of physical assets and the development of sophisticated depreciation and maintenance accounting. The company owned substantial fixed assets, warehouses in multiple cities, office buildings, ships, furnishings and equipment, even some real estate held for investment rather than operational purposes. All of these assets were recorded in the accounts at their original cost, with separate accounts for each major category. And the accounting system had to deal with the question of how to reflect the loss of value over time as these assets aged and deteriorated. For buildings, the Alberti accountants used a method that we might call reserve-based depreciation, though they did not use that term. Each year, they would estimate the amount that would need to be spent on major repairs and maintenance over the building's life, and they would set aside a portion of this amount annually, creating a reserve account that would accumulate over time. When major repairs were actually made, the costs would be charged against this reserve rather than against current income. This smoothed out the impact of lumpy maintenance expenses and created a more accurate picture of the ongoing cost of owning buildings. The calculations behind these reserves were quite sophisticated, based on careful observation of how buildings actually deteriorated and what kinds of repairs were needed at what intervals. The accounts from the Florence head office show that the building required repainting every 5 years at a cost of about 200 florins, roof repairs every 10 years at 500 florins, and major structural work every 25 years at 2,000 florins. Based on these estimates, the accountants calculated an annual reserve requirement of about 160 florins, which was duly recorded each year as a debit to maintenance expense and a credit to the building reserve account. When actual repair work was done, the detailed invoices from contractors were preserved in the archive, cross-referenced to the accounting entries, creating a complete audit trail. For ships, the depreciation method was different because ships had a more predictable, useful life and typically needed to be replaced entirely rather than incrementally repaired. The Alberti accounts show ships being depreciated over an expected life of 10 years, with 1/10 of the original cost charged to expense each year. This created annual depreciation charges that were substantial, typically 200 to 400 florins per ship, but that accurately reflected the reality that ships wore out and needed to be replaced. The accumulated depreciation was tracked in contra-asset accounts that reduced the book value of the ships so that the balance sheet showed both the original cost and the remaining book value after depreciation. Interestingly, the accounts also tracked actual ship maintenance expenses separately from depreciation, recognizing that ships needed ongoing repairs to remain seaworthy even as they lost value. The maintenance expenses were quite detailed, showing costs for replacing sails and rigging, caulking and painting the hull, repairing or replacing masts and spars, all the myriad work that keeping a wooden ship afloat required. Over the typical 10-year life of a ship, the cumulative maintenance expenses often approached or even exceeded the original purchase price, meaning that the total cost of operating a ship was roughly double its initial cost. This information was crucial for pricing shipping services and for deciding when it made economic sense to replace an old ship rather than continuing to pour money into repairs. The Alberti accounts also reveal sophisticated inventory management practices, with detailed tracking of goods held in various warehouses and in transit between locations. The inventory accounts were organized by type of merchandise, with separate accounts for wool, cloth, silk, spices, dyes, wine, grain, and many other products. Within each category, the accounts tracked quantity, cost, and location, allowing managers to see at a glance how much of each product they had and where it was. This information was essential for making purchasing and sales decisions, for ensuring that inventory levels were appropriate to meet anticipated demand without tying up excessive capital in slow-moving goods. The accounts show the company using a method we would recognize as weighted average cost for inventory valuation, calculating the average cost per unit based on all purchases during a period and using this average to value both inventory and cost of goods sold. This method was simpler than trying to track the specific cost of each individual item, which would have been impractical given the volumes involved, and it provided reasonable results for financial reporting purposes. However, the accountants also maintained separate records showing the actual cost of specific batches of goods, because this information was sometimes needed for pricing decisions or for calculating profits on particular transactions. One aspect of inventory accounting that the Alberti handled particularly well was the treatment of goods in transit, merchandise that had been shipped from one location but not yet arrived at its destination. These goods were in a kind of accounting limbo, no longer at the origin but not yet at the destination, and it was crucial to track them carefully to avoid either double counting them or losing track of them entirely. The Alberti system used in-transit accounts that were debited when goods were shipped out of one location and credited when they arrived at another, with the balance in these accounts representing goods currently en route. The quarterly consolidated statements included schedules showing all in-transit shipments, with details of what was shipped, when, on which ship or via which route, and the expected arrival date. These in-transit schedules were critically important for investigating discrepancies and losses. If goods were shipped but never arrived, the in-transit account would remain out of balance, alerting management to the problem and triggering an investigation. The accounts from 1426 document one such case, where a shipment of valuable silk cloth was dispatched from Florence to London but never appeared in the London branch accounts. The investigation, meticulously documented in correspondence and accounting memos, revealed that the goods had been stolen in transit, probably by members of the merchant caravan that was transporting them overland to the port. The loss was ultimately charged to the insurance account, as the shipment had been insured against theft, and the insurance company paid the claim after conducting its own investigation and verifying the details against the accounting records. The level of detail in the Alberti inventory records is truly remarkable, extending even to tracking the specific characteristics of individual items when this was relevant to their value. For example, wool was graded by quality, with separate inventory accounts for fine English wool, medium-grade Castilian wool, and coarse local wool, because these different grades had very different costs and selling prices and could not be treated interchangeably in the accounts. Similarly, cloth was tracked by type, quality, color, and sometimes even by the specific weaver who produced it, because all of these factors affected market value. This detailed inventory tracking required enormous clerical effort, with warehouse workers physically counting and categorizing goods, with this information then being transcribed into the accounting records, but it provided management with precise information about what they owned and what it was worth. The accounts also show sophisticated handling of obsolete or damaged inventory, recognizing that not all goods could be sold at their original expected prices. At the end of each accounting period, managers were required to review their inventory listings and identify any items that were unlikely to sell at full price, either because they were damaged, out of fashion, or simply slow-moving. These items were written down to their estimated realizable value, with the write-down charged to current expense, and the inventory carrying value reduced accordingly. This conservative approach to inventory valuation ensured that the balance sheet did not overstate assets, that profit calculations reflected realistic assessments of what could actually be recovered from inventory sales. One particularly interesting example from the accounts involves a large quantity of red cloth that the Alberti Barcelona branch had purchased in 1427 in anticipation of strong demand. Unfortunately, fashion preferences shifted unexpectedly, and customers began preferring blue and green cloth instead. After several months of trying unsuccessfully to sell the red cloth at the hoped-for prices, the Barcelona manager had to admit defeat and mark down the inventory by 40%. The accounting entry recorded a loss of 2,000 florins, a significant hit to the branch's profitability, and the consolidated financial statements for that quarter showed Barcelona's profit falling dramatically as a result. This episode sparked a discussion among the partners about inventory risk management, about how to balance the desire to have goods available for customers against the risk of being stuck with unsellable inventory. A discussion that was itself documented in the accounting records through a series of policy memos and directives. The treatment of real estate in the Alberti accounts is another area of sophistication worth examining. The company owned properties in multiple cities, some used for business purposes like warehouses and offices, others held as investments with the intention of generating rental income or capital appreciation. These properties were recorded in separate accounts at their purchase cost, with detailed records of the location, size, and characteristics of each property. Rental properties generated income that was recorded in rental revenue accounts, while also incurring expenses for maintenance, property taxes, and management that were tracked in corresponding expense accounts. What makes the real estate accounting particularly interesting is how the Alberti handled property appreciation, the increase in value that occurred over time as cities grew and properties became more valuable. Medieval accounting did not generally recognize unrealized gains, increases in value that had not been realized through an actual sale, and the Alberti followed this conservative approach, continuing to carry properties at their original cost even when everyone knew they were worth much more. But the accountants maintained supplementary records, not part of the formal double-entry books, that tracked estimated market values based on periodic appraisals and comparable sales. These supplementary records gave management a realistic picture of the company's wealth, even though conservative accounting principles prevented them from booking the gains in the official financial statements. When properties were eventually sold, the gain was calculated as the difference between the sale price and the original cost, and this gain was recorded as extraordinary income separate from operating profits. The accounts from 1428 show the sale of a warehouse in Venice that had been purchased 20 years earlier for 5,000 florins and was sold for 12,000 florins, generating a gain of 7,000 florins. This gain was broken out separately in the financial statements to make clear that it was a one-time event rather than recurring operational income, helping readers of the financial statements understand the true sources of the company's profitability. Now let me address one final dimension of the Alberti accounting system that was perhaps its most important innovation: the development of what we might call management accounting. The use of accounting information not just for external reporting to partners and creditors, but for internal decision-making and control. The quarterly financial statements were certainly used for external reporting, but the company also generated numerous internal reports designed to help managers run their operations more effectively. These included reports comparing actual results to budgets or forecasts, reports analyzing the profitability of different product lines or customer segments, reports tracking key performance indicators, like inventory turnover or receivables collection periods, reports highlighting exceptions and anomalies that required management attention. The budgeting process was particularly sophisticated. At the beginning of each year, each branch manager was required to prepare a detailed budget showing expected revenues, expenses, and profit for the coming year, broken down by quarter. These budgets were based on analysis of historical performance, adjusted for anticipated changes in market conditions, volumes, prices, and costs. The branch budgets were consolidated into a company-wide budget that was reviewed and approved by the partners, who might request revisions if they felt the assumptions were unrealistic or the projected results were unsatisfactory. Throughout the year, actual results were compared to budget, and significant variances triggered investigation and explanation. If a branch was falling short of its profit target, the manager had to explain why and what corrective actions were being taken. If a branch was exceeding expectations, there would be questions about whether the budget had been sandbagged, set too low to make performance look good. This budget variance analysis, documented in quarterly management reports preserved in the archive, created accountability and drove performance improvement in ways that would be familiar to any modern corporate controller. The profitability analysis reports show the Alberti accountants breaking down profits in various ways to gain insights into which parts of the business were working well and which needed attention. One report format showed profit by product line, comparing wool trading versus silk trading, versus spice trading versus banking, allowing the partners to see which businesses were contributing most to overall results. Another format showed profit by geographic market, comparing performance in different cities and regions. Yet another showed profit by customer type, distinguishing between wholesale and retail customers, between one-time transactions and repeat business, between local customers and foreign correspondents. These profitability reports revealed counterintuitive insights that changed how the company operated. For example, the analysis showed that while the spice trade generated the highest profit margins, it also tied up capital for the longest periods, as spices had to be transported over vast distances and warehoused while awaiting buyers. When you calculated return on capital employed rather than just gross margin, the wool and cloth business actually looked more attractive despite its lower margins, because capital turned over much faster. This analysis led the partners to rebalance their capital allocation, investing more in the textile business and somewhat less in spices than they had previously planned. Similarly, profitability analysis by customer revealed that the company's largest customers were not always its most profitable. Large customers had bargaining power that allowed them to negotiate favorable prices, and they also tended to be slow payers, extending their payment terms and effectively getting free credit from the Alberti company. Smaller customers paid higher prices and settled their accounts more promptly, generating better returns even though individual transaction sizes were modest. This insight led to a more nuanced customer strategy, with efforts to cultivate mid-sized customers who lacked the bargaining power of the giants but had more potential than the smallest buyers. The Alberti also developed key performance indicators that were tracked monthly and reported to management, providing early warning of potential problems. One such indicator was the receivables collection period, calculated as average accounts receivable divided by average daily sales, showing how many days it took on average to collect payment from customers. The target was 60 days, and if any branch exceeded 90 days, it triggered automatic review and investigation. The accounts show this indicator being carefully monitored, with branch managers held accountable for keeping their receivables under control and for taking prompt action against slow-paying customers. Another key indicator was inventory turnover, calculated as cost of goods sold divided by average inventory, showing how many times per year the company sold and replaced its inventory. Higher turnover was generally better, as it meant capital was being used more efficiently, though the optimal level varied by product line. Wool and cloth had target turnover of 4 times per year, meaning inventory should be held for an average of 3 months, while spices had a lower target of 2 times per year because of longer supply chains and less frequent trading cycles. The quarterly management reports showed actual turnover rates by product line and by branch, highlighting areas where inventory was building up and capital was being tied up unproductively. These management accounting practices represented a significant advance over the simple record-keeping that most medieval merchants practiced. The Alberti were not just tracking what had happened, but using accounting information to understand why it happened and what should be done differently in the future. They were turning data into information and information into action, demonstrating the power of accounting as a management tool rather than just as a compliance requirement or historical record. As I bring this extended story to a close, I want to reflect on what the Alberti experience tells us about medieval accounting more broadly and about the continuity between medieval and modern practices. The Alberti accounting system, sophisticated as it was still recognizably medieval in many respects. It was manual, requiring armies of clerks laboriously writing entries by hand and performing calculations using pen and paper or counting boards. It operated in an environment without standardized accounting rules, where each company developed its own practices and terminology. It dealt with currencies and measures that varied bewilderingly from place to place, requiring constant conversion and reconciliation. It struggled with communication delays that meant information was always somewhat out of date, that problems might fester for months before being detected. And yet, when you read through the Alberti accounts, when you see the careful attention to consolidation and variance analysis, to budgeting and performance measurement, to risk management and internal control, you cannot help but be struck by how modern it all seems. The specific techniques have evolved, the technology has changed beyond recognition, the scale and complexity of business operations have increased by orders of magnitude, but the fundamental challenges remain the same. How do you measure performance accurately? How do you allocate resources effectively? How do you ensure that people throughout the organization are working toward common goals? How do you detect and prevent fraud? How do you provide information that enables good decision-making while not overwhelming users with excessive detail? These are the eternal questions of accounting, as relevant in the 15th century as they are today. The Alberti company itself did not survive much beyond the middle of the 15th century. Political upheavals in Florence, bad loans to governments that defaulted, a series of partnership disputes that split the family, all contributed to its gradual decline and eventual dissolution. But the accounting practices that the Alberti developed, the innovations in consolidation and budgeting and management reporting, these outlived the company itself, spreading to other merchant houses through the movement of trained accountants from one employer to another, through the publication of accounting manuals and treatises that codified best practices, through the general accumulation of commercial knowledge that characterized the late medieval and early modern period. The Alberti were part of a broader movement toward professionalization and systematization of accounting, toward treating it as a discipline with principles and methods that could be taught and learned, rather than merely as a craft that each practitioner reinvented for themselves. And this brings us back to where we began, to the broader significance of medieval accounting as a cultural achievement, as a technology of thought that changed how people understood and interacted with the economic world. The Alberti accountants, like their counterparts at the Medici Bank and the Tatimi Company, and hundreds of other merchant houses across medieval Europe, were engaged in something more profound than simply recording transactions. They were creating new forms of economic visibility, making it possible to see patterns and relationships that had previously been invisible, to think systematically about profit and loss, risk and return, assets and liabilities. They were developing the intellectual infrastructure of capitalism, the conceptual tools without which modern economic organization would be impossible. When we study medieval accounting today, when we pore over these centuries-old ledgers with their faded ink and their elegant script, we are not just engaging in antiquarian curiosity or academic archaeology. We're exploring the foundations of our own economic system, tracing the roots of practices and concepts that still shape how businesses operate and how we think about economic life. The double-entry system that some anonymous Italian merchant invented in the 13th or 14th century is the same system that underpins the financial statements of every major corporation today. The principles of consolidation and variance analysis that the Alberti developed in the 1420s are essentially the same principles that modern accountants apply. The eternal tension between accuracy and timeliness, between detail and summary, between conservatism and realism. These tensions that we see playing out in medieval account books are the same tensions that accountants grapple with in every age. So, as we conclude our exploration of medieval accounting through these stories of individual merchants and their companies, I hope you will appreciate not just the technical details, fascinating as they are, but the larger human drama of people trying to understand and master the economic forces that shape their lives, of building institutions and practices that would endure long beyond their own lifetimes, of creating something genuinely new in human civilization. The medieval accountants were pioneers, explorers of the quantitative frontier, and we are all their heirs, living in the world that their innovations made possible. Their account books, preserved in archives across Europe, are monuments to human ingenuity and persistence, testaments to the power of systematic thought and careful record-keeping. And they deserve to be remembered and studied, not as dusty relics, but as living documents that still have much to teach us about how to organize economic activity effectively and ethically in any age.